Trump is very clear about what he wants to do, and investors need to take that seriously.
I think the market understands that tariffs are going to be part of this agenda, and I think they've digested that already.
This is a game of chicken, and it has to be treated as such.
There's still weakness within the economy. You can see the bifurcation, and that to me still raises risk. And you have an equity market that is priced for perfection.
The hard part about these type of things is just the unpredictability of it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to a very long weekend. Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now, coming into Wednesday at all-time highs on the S&P 500, a 7-day winning streak. Equity futures right now shaping up as follows, down just 0.1% on this Thanksgiving Eve. On the Nasdaq 100, we're down by 0.3%. Brace for 8:30 Eastern Time. What a data dump we'll get. Jobless claims, PCE, and another read on GDP, so look out for that. But we have to begin this morning with the President-elect's men. The economic team coming together. Kevin Hassett over at NEC, Jameson Greer, USTR, Scott Besson at Treasury, Howard Lutnick at Commerce. We have a more complete picture this morning.
And the focus this morning really is on Jameson Greer, who is the U.S. trade rep and an acolyte of Robert Lighthizer. This idea that he talks about China as a generational challenge and calls for an entire decoupling with the U.S. from China. I just want to read this. There is no silver bullet, and in some cases, the effort to pursue strategic decoupling from China will cause short-term pain. However, the cost of doing nothing or underestimating the threat posed by China is far greater. That is who is going to be coming in to be the trade representative.
Let's talk about where the pain is. The pain wasn't the headline equity market yesterday. The S&P 500, another all-time high. It's in foreign exchange, just a little bit. Just to go through some currency pairs for you. Dollar Mex, the highest level since 22. Weaker Mexican peso. Dollar Canada hit the highest since 2020, a weaker Canadian currency. And then some single names. GM yesterday. GM, Lisa, got absolutely hammered.
A number of studies showing that both GM and Ford will probably see a $3,000 increase to the prices on their cars because of the tariffs and how they're being imposed. Let's just be clear. A lot of these companies have tried to get ahead of decoupling from China by moving operations to Mexico. So now the question is, if Mexico is being treated as a backdoor for Chinese parts to come into the United States, how much is it sort of a whack-a-mole? Where can you move quickly and where can you move fast before getting penalized? And GM and Ford are finding themselves yet again in the crosshairs.
So the team at Bernstein had a great note out on this yesterday. I'm not sure if you all saw it, but there's some great stats in it. GM and Stellantis import 55% of trucks sold in the United States from Mexico and Canada.
I mean, honestly, you look at the pipelines and they've gotten completely rerouted to Mexico and Canada. Here are some statistics about why there is a strong response right now from Mexico and Canada. The U.S. accounted for more than 83% of the exports from Mexico. So, yes, it is a direct pipeline, and they've had a huge complex built up, particularly at the auto manufacturing sector. 75% of Canadian exports. This is a massive block that accounts for $1.8 trillion of trade. And you look at this, you wonder, how much can you actually torpedo that with 25% tariffs?
General Motors this morning bouncing back by just 0.6% after dropping yesterday by 9 full percentage points. Coming up this hour, we'll catch up with John Stoltzfus of Oppenheimer with stocks at all-time highs. Bloomberg's Mike Shepard as Donald Trump completes his economic team, and Norman Roule of CSIS on Israel and Hezbollah's ceasefire deal. We begin this hour with stocks at all-time highs following 7 straight days of gains. John Stoltzfus of Oppenheimer remaining positive on equities and saying, quote, the broad rotation, which began in the rally from last year's S&P 500 low on October 27, 2023, has repeatedly deflected volatility. John joins us now for more. John, good morning.
Good morning.
Once again yesterday, deflecting volatility. Was that just another data point for you?
Well, it was another data point, but in a series of data points that reflect the change in where we are. And in essence, what it is people are beginning to realize that this bull market has legs. There is a broadening that is undeniable in terms of the way investors have responded to their appetite for equities. I'd also say, I think from a historical perspective, a lot of times the market is perceived as a place, as a hotbed of fear and greed, but it also represents need. And the need is extraordinary these days in terms of people's planning, whether it's for a kid's education, one's retirement, in a world in which Social Security may not be any much the part of where it has been before.
These are big themes for the next several years and maybe even the next several decades. forever, our lifetime. I want to deal with the last 24 hours first, and then we can get to the bigger themes. Do you not think the threat from Donald Trump, president-elect, is credible? Does this market not believe it's credible? Or is there really something to take away from this to sit here and say, actually, this equity market can handle it? It's resilient enough?
A combination of the two in terms of the equity market being able to handle it. But the important thing is the market really cares ultimately about revenues and earnings. So areas that will be damaged by an aggressive trade policy with tariffs that are extreme would be problematic. That said, I think the market is recognizing that President Trump is essentially known for pretty wild negotiation procedures. I mean, I always like to say when I speak with investors that if I can just imagine if you had a property, and this would be a small amount of money in New York, but that you knew was worth about $100 million and you wanted to sell it to Donald Trump, my guesstimate is he'd start out with, I think it's worth $20 million. You know, he's a hard negotiator. And I think the issues here that I think you mentioned at the beginning where you're talking about as they put this, the cabinet together, is that this is what we're dealing with here are genuinely unfair trade situations for the American worker, essentially, and for American businesses. And the problem is, how do you get to right-size that with so many countries really providing support to their businesses very different than ours, where we have high regulation, we have all kinds of our labor is much more expensive because we provide better for our workers.
So is it fair to say that what you're basically indicating is that this is a market that isn't taking it seriously, that Trump is actually going to put through any of this, and that's not what's getting priced into markets at all?
Well, I wouldn't say it's not being priced into markets at all. The traders certainly reflect it. Just as you mentioned, one of the automakers yesterday got slammed. You know, when you get to that kind of a thing, without a doubt, there's volatility inherent in this procedure. But it's likely the whole thing that Trump ran on was essentially to be beneficial for the U.S. And I think these are 4 years that he's got, and he's not got 4 years after this in terms of running again. So I think they're going to be very sensitive to it. It should look. There's going to be volatility. There always is. There's always uncertainty. But if you got to keep your eye on the ball, and it looks like through innovation, the process of where we are today, and that the U.S. is the consumer of choice for every vendor in the world. Puts us into a fairly good position that the negotiations may originally start out pretty painful to look at, and then things actually work out remarkably better.
Some people are saying this is the 5th year of his administration. Essentially, it's a continuation of policies that had been in place. There are a number of people who have begged to differ with that, saying this is a very different circumstance economically than it was in 2016. Inflation is more of a real risk. Mm-hmm. There's more momentum. Companies are already in a good spot. The deficit is a lot steeper, and people are worried about bond yields. How much does that temper the ability to really implement some of these policies? How much are you watching the bond space to understand how bullish to get in equity land?
Oh, we definitely watch the bond space because everything works on credit, right? I mean, it doesn't matter if it's related to the consumer's credit card or what businesses are doing in terms of their borrowing needs and refinancings and M&A, what have you. But what we'd have to say is, I think realistically, it's the end of free money, and it's a good thing in that bond issuers once again have to pay for the privilege of borrowing money. Our projection on the 10-year yield is, because of the stickiness that's inherent in inflation when you're coming out of a period like this, 10-year probably to range, being priced to range its yield somewhere between 3.4% to as high as 5%. At 5%, everybody gets freaked out. Then you come down back to about 4.2 where we are now. Yep. But historically, it's you go back hundreds of years. When it comes to 10-year borrowing, 4% tends to be about it. Whether you're borrowing for frankincense and myrrh, or you're peppercorn or whatever in Venice.
We're doing the nativity scene. It's Thanksgiving first, John. Okay. Let's get to some price targets. The next year or so. Morgan Stanley 6,500, RBC 6,600, BMO 67, Deutsche Bank's biggie charter 7K. Don't know what you think about that. I was talking about you yesterday. The average forecast on the S&P for this year was 4,800. You were at the high of 5,200, and you weren't bullish enough.
Yeah.
What's the lesson of 2024 been? Before we get into 2025, what's the lesson been for you?
That's a real good question. It's the second time you've asked me that question. What's the lesson been in the year? And it's a great question.
We did this last year too,
and
the year before.
And we'd have to say with this is, we started last year. Last December we had 5,200. By March we raised it to 55. By July we went to 59, and most recently we went to 6,200 for this year. The thing that concerns me the most at this point is that the people that you mentioned were a mix of bears and bulls who have these high targets. So everybody's on the same side of the boat, which makes the market vulnerable to volatility that can come about from any piece of economic data, corporate guidance, or anything. The traders will jump on anything, and they'll take it, and they'll throw a perfectly good stock down like a hot potato, okay? Meantime, it creates an opportunity for those need investors who are investing intermediate to longer term for their goals and objectives to pick up babies that get thrown out with the bathwater. So you have to measure that. Our target won't come out until mid-December as usual. We wait until people have gotten pretty crazy and take a look what happens. But we do have to say it's rather disconcerting when you hear people throwing around targets, 7,000. It sounds dramatic, but when you actually put it to the calculator, the percentage upside based on the innovation that exists, the ability for companies to navigate tougher waters as a result of the experience that managers have learned from the great financial crisis, the pandemic, the supply chain disruptions, and then the balance sheets of the consumer. It looks like stocks could genuinely go quite a bit higher.
Which is why so many people think we can get double-digit returns next year. We've talked about this as well. As human beings, we are conditioned to overweight downside risk. We can spend the whole morning talking about downside risk. Lisa will no doubt want to do that. What could go right in 2025? What do you think could go right?
Well, I think among the things that could go right would be continued resilience in revenue and earnings growth on a broad basis. I mean, if you look at the EA page on a Bloomberg right now, you've got 4 sectors with double-digit returns. I think it's 8 sectors with, 4 sectors with double-digit earnings growth. You have 8 with positive earnings growth, and you have 3 with negative earnings growth. So the dispersion that you see in that tells you that, it's real. There's things that are really working, things that are somewhat working, and some things that aren't. And in that kind of an environment, based on what we've seen, the big surprises could be that resilience continues as an operative word in the markets, and that perhaps that we see that when the actual negotiations work out, that the countries involved will actually come to terms more readily because of the importance of the American consumer and American business.
You put that together with something that you said, that when there is a bad headline, the companies just get dropped like a hot potato. I'm thinking of Target, Best Buy, Dell, and HP yesterday when they came out with weaker than expected earnings. What's your lens for knowing when it's a good opportunity, when you should actually pick that up?
Well, when we look at companies, one of the reasons why I can't mention individual companies, Oppenheimer doesn't like me to pitch my own stocks, right? But when we look at the companies, what we're always looking for, it's the traditional. It sounds very easy out to say this, but it essentially is good balance sheets, management that cares about their shareholders and their customers and their employees, and good ideas that they're managing through, and hopefully some kind of an upgrade cycle in technology. The thing is, we're all on the upgrade cycle, whether we like it or not. Ultimately, I will have to upgrade both my my iPhone 14, neither a recommendation to buy or sell Apple stock, and I will also have to update my 6S. Which I can
Which you still got, I know.
Which I know, which is it's like an old Model T.
It's like an advertisement.
John, we're thankful for your optimism. Thank you, sir. Have a happy Thanksgiving with the family. Appreciate it.
Same to you,
It's good to see you. Thank you. John Stoltzfus there of Oppenheimer. Equity futures right now on the S&P down by about 0.2%. With an update on stories elsewhere this morning, here is your Bloomberg brief. A ceasefire between Israel and Hezbollah starting early this morning. The 60-day truce putting a pause in the 14-month conflict that's killed thousands. and forced more than 1 million people to flee their homes. Elsewhere, Goldman Sachs warning the US consumers will face significant consequences from Donald Trump's proposed tariffs on Canada. The head of the commodity research team saying the 25% levy would raise fuel prices in the US, which imports almost 4 million barrels of Canadian crude a day. And finally, as Lisa mentioned, shares of Dow and HP are falling in pre-market trading. Both companies reported revenue that missed analyst estimates, suggesting a longer-awaited recovery for the personal computer market is stalling. Lisa, Dow down 12%.
Yeah, this is interesting to me. Everyone's talking about how there's going to be an upgrade cycle, whether it's iPhones or whether it's personal computers after the pandemic when everyone had 15 screens in front of their face to distract from the fact they couldn't go outside. But there is this question of why it's getting delayed. Is it because the technology isn't there yet? Is it because people aren't interested yet? And that holds the key to the expansion of some of the AI adoption.
Are we all waiting for the grand upgrade? I think some people are with Apple.
Yeah, some people. I don't know. The Faro Index is suggesting maybe
some people
not,
around this table.
because some people around this table aren't that interested yet. So
Still
we'll see.
Still waiting. Came close last night, honestly.
Really?
Phone battery died.
Ooh.
I would have stayed in bed, missed the show.
Oh, yeah, right. Whatever.
Yeah, real deal.
It actually
Almost
almost
happened. Midnight last night.
Really?
Rolled out, saw the phone was dead. Quickly ran to get the watch to check the time. Thought,
Wow.
you know, who
It's like,
knows?
all I know-
Might
all I
be
know.
5:30.
Watch, you're going to get a text. We're your local Apple dealer. Come join us later today.
I'm here for the next 2 hours and 45 minutes. Up next on the program, President Trump making a statement.
I believe that he's stepping up and making this statement about tariffs to tell both Canada and Mexico we have got to get our border security in the United States squared away.
That conversation up next. Live from New York this morning. Good morning. Squeezing absolutely everything in ahead of Thanksgiving. So at 8:30 Eastern Time, jobless claims, PCE, and another read on GDP. Equities into that on the S&P 500 down by 0.2% following a 7-day winning streak on the S&P. Under surveillance this morning, President Trump making a statement.
I believe that he's stepping up and making this statement about tariffs to tell both Canada and Mexico we have got to get our border security in the United States squared away. And then secondarily, I think he's very concerned about imports from other countries that are going to try to take advantage of the USMCA. He's also using it as a lever to get serious conversations in Ottawa and Mexico City with Washington.
So here's the latest this morning. Donald Trump's economic team coming together after doubling down on tariff promises. The president-elect naming Kevin Hassett to lead the National Economic Council, Jamieson Greer as U.S. Trade Representative. Greer entering the role as a long-time apprentice of Robert Lighthizer, who oversaw billions in tariffs under the first Trump administration. Mike Shepard joins us now from the nation's capital for more. So, Mike, the team's basically almost complete now. What's the biggest signal that you take away from these selections that President-elect Donald Trump has made so far?
Well, as Congressman Hill said yesterday, the president-elect is sending a message, but I think the message we're taking from this latest round of appointments, which dropped in the evening hours on Tuesday, is that he will really follow through on this tough stance toward China. By picking Jamieson Greer, he is selecting someone who is not only known as a China hawk, which is something that's in vogue here in Washington, but somebody who falls to the more severe edge of the spectrum there. At the top of the hour, you heard Lisa talk about how Greer has favored this so-called strategic decoupling from the world's second largest economy. And that's a step even the Biden administration's trade architects, led by Catherine Tai, the current trade representative, and Commerce Secretary Gina Raimondo, they have not been willing to say that. In fact, they've gone to great pains to say that they still want to do business with China. But Greer is making the case that, look, China poses this kind of generational challenge, and we really need to maybe break away from them a little bit.
Mike, a big debate happening on Wall Street is just how credible that threat might be. So if we go over the proposed tariffs of the last 48 hours, an additional 10% on a tariff of imports on Chinese product, 25% tariffs on products from Mexico and Canada. Mike, I think a lot of people in the market just don't believe that's going to happen. What's the conversation sound like in Washington? Is it any different?
Well, no, it doesn't. I think a lot of people are looking at this, again, as part of a negotiating ploy perhaps by the president-elect, but there's an important distinction to be drawn with what the president-elect said late Monday about Canada and Mexico and China even when it comes to those specific tariffs. Those were aimed at policy goals, curbing the flow of fentanyl into the U.S. and doing something about the border. And we saw a quick response from Canada and even Mexico on this. Tonally, they were a bit different. And even China responded in kind, albeit more briefly. By looking at the selection of Jamieson Greer, we are seeing that something broader in the direction of travel in terms of economic ties. And he has, when we talk about strategic decoupling, he has also favored revoking China's permanent normal trading status. And this is a category that Beijing was first awarded back in 2010 by the U.S. This allows it to compete like most other nations in the world. Revoking PNTR would mean that China would fall back into the category of Russia, Cuba, and North Korea and automatically subject its goods to much higher duties. And that would put China on the back foot with the world's largest economy, just as Xi Jinping is trying to get his own economy in order at home.
It strikes me, Mike, that Wall Street is a bit confused about just how much this is a negotiating tactic versus very much for real and going to be implemented. I think a lot of people are, but adding to that confusion is that a lot of people who have been named to cabinet positions are former Wall Street acolytes. I'm talking about the likes of Jim O'Neill, formerly CEO of the Thiel Foundation. I'm talking about John Phelan, formerly of Dell. He was Michael Dell's money manager. He is somebody who's entrenched in Wall Street. How much is that at odds with one another? The idea that Wall Street has tended to look for more moderate responses when it comes to trade, especially when it comes to some of these big international companies.
Well, one important name to include in there also is Trump's nominee to be Treasury Secretary, and that's Scott Bessent, who was seen by many as a potentially moderating force when it comes to this confrontational elbows up approach on tariffs and trade. And yet with the selection of Jamieson Greer, we may be sensing some tension baked into the team when it comes to how the U.S. presents itself economically and relates with the rest of the world economically as well. Now, the feedback we're going to be seeing from the business community, not only Wall Street, but large manufacturers and especially Silicon Valley, which have enormous ties in their business with China, they will be questioning this, and they also have the president's ear in a lot of ways. Apple CEO Tim Cook enjoyed a cordial and open relationship with Donald Trump during the first Trump presidency. So we could see Tim Cook again and other CEOs trying to gain that kind of access and gain the president's ear to maybe talk him out of going down the path of most severe actions toward China when it comes to tariffs and other restrictions like export controls that we've also seen the Biden administration start to roll out against China as well.
Mike, who's left? Who do we want to see who could potentially need to really get filled?
I think we've really seen most of the team filled out, to be honest. These are the key positions right now. And what we now need to see is what they're actually going to do. And while we've leaned into Jamieson Greer's past comments, we now need to see them start to put some form around what they might actually do once they take office in January. And remember, Trump wants to hit the ground running, so we may start learning about some of these proposals soon.
Hey, Mike, good to hear from you, sir. Great to catch up with you, Shep. Mike Shepard there, down in Washington, D.C. Two names not mentioned. One, where's Ambassador Lighthizer? Where does he end up? And two, Kevin Walsh. I wonder what happens with Kevin Walsh in the next 12 months.
Yeah, especially if we have a Fed chair or if that is sort of undermined in some capacity.
A shadow Fed chair, maybe.
That was something that Scott Bessent floated a bit ago.
Up next, the latest in the Middle East from New York. This is Bloomberg. Seven-day winning streak on the S&P 500. Equities pulling back just a little bit. We're down 0.2%. On the Nasdaq 100, we're down by 0.4. Big tariff threats from President-elect Donald Trump, and yet we closed yesterday at all-time highs. Why? Why are we taking this all in our stride? This is the take from the CIO team over at UBS. The timing and narrow focus suggests scope for negotiation. The fundamental backdrop remains supportive. Hence, equities at all-time highs and these little pockets of landmines going off here and there.
Yeah, you're talking about, for example, auto manufacturers. We start to see GM, and you see if you price out what this could look like, you're talking about price increases that could be quite significant. So here's the question. Is this a negotiating tool, or is this just hubris on the part of markets to look past it and say, this is just going to blow over too? And I do think there is a note of skepticism this morning when you see who is put into the cabinet positions. This is ideological. This is not a negotiation for them.
This is tariffs first.
Yes.
That's for sure. In the bond market, 2-year, 10-year, 30-year yields dropping. Once again, yields have been dropping all week. We're down 4 basis points at the front end, down 4 at the longer end on a 10-year, 426.92. Said this a few times that at 8:30 Eastern time in 2 hours from now, you'll get a ton of economic data. But the big three, December 6th payrolls, 11th CPI, 18th a Federal Reserve meeting.
Today's PCE, though, is actually going to be really interesting because what we're looking at is the potential for any offset, any potential bad news when it comes to disinflationary path to push Fed officials away from cutting rates next month. And that's what we heard in some of the meeting minutes yesterday, that they could cut, they could not, we'll have to see, we don't know, what's neutral rate, gradual.
Yeah.
I mean, really, what information did we learn yesterday?
A lot's changed. They haven't changed too much just yet. Wait until December 18th. They want to model some tariffs. Well, they've got some tariffs to model, haven't they? Let's turn to Europe. So for the last few weeks, it's been US, America, America, America. That's where the fireworks are. In Europe, check out the spread between a French 10-year and a German 10-year. Approaching 100 basis points, the widest since 2012. France has been trading tighter to Greece than Germany for quite a while now, and I think that's an important point to make. The Prime Minister's ability to pass a budget and cut spending is the big focus at the moment. Le Pen is threatening to basically bring down the government, and I think this just all reinforces broader worries about the continent, a continent distracted at a time when they really don't want to be.
A continent that can't afford the same kind of fiscal dominance the United States does. And what you see is that bond vigilantes have a much greater presence over in Europe, and particularly when it comes to France. And it shows a real reordering, frankly, of the economic backdrop. It used to be that Germany was the powerhouse. France was this close number 2. And then you had, Italy and Spain and some of the others out there. Now it's actually different in Greece. Those are actually doing a lot better, and people are saying, actually, those are the stronger profiles. So it raises a question. Where is the growth engine going to come from, and where is the political leadership going to come from at a time where the two biggest economies are both in absolute political turmoil?
And what is Europe sleepwalking into? More specifically, what is the ECB sleepwalking into? Executive board member Isabel Schnabel, who I have a tremendous amount of respect for. I think she's one of the clearest communicators in central banking anywhere, at any central bank worldwide. But that doesn't mean that we can't criticise some of the substance of a recent speech. She was talking about structural issues in Europe. And if Europe's struggling because of structural issues, can we really address them with lower interest rates? Would that be a waste of ammunition to address that when something should be happening elsewhere? And really, that just raised the very real prospect of the ECB not doing much at all.
Yeah, verbatim. This is what she said. Given the inflation outlook, I think we can gradually move toward neutral based on incoming data. I would warn against moving too far. That is into accommodative territory at a time where other people are saying this is a region that faces an existential economic threat and needs all the help that it can get. So it raises this question, are they playing a game that has already been made out of date?
Euro-dollar at 105. Under surveillance this morning, President-elect Donald Trump completing the bulk of his economic team, naming Kevin Hassett to direct the National Economic Council and Jamieson Greer as U.S. trade representative. Elsewhere, Canada and Mexico responding to Trump's tariff threats. Canada saying it has plans to boost border security and pointing to U.S. government data showing most fentanyl problems come from Mexico. Mexico, Lisa, suggesting it could respond with tariffs of its own.
My favorite is Mexico is saying, all right, you want to play that game? Get ready for a trade war. It's going to hurt everybody. Just watch it. Canada, we're not the problem. It's them. We're not the issue.
Canada's saying we're not Mexico.
We're not Mexico. Please, come on, back it off. And that's essentially the response that you get. Again, this goes into how much do we take this seriously versus the tit for tat to try to get some policy upper ground before starting the administration.
I know many of you are hitting the road later on this morning and this afternoon, so let's get you some numbers. AAA expecting record-setting travel numbers for Thanksgiving. The agency estimating nearly 80 million people will travel 50 miles or more for the holiday this year. That's 1.7 million more people than the previous record set just last year.
I feel like this is a sports game. We see, what's the tally going to be of delays and pain after the fact? If we sort of show the lines, we show this, and then we figure out, okay, where did the breakdowns happen? And if things go smoothly, it's like, all right, great, I'm glad everyone had a good holiday. But that's sort of how it feels. And this time in particular, I want to hear how long the lines are at security, whether Clear actually works, how much people get angry about the fact that Clear goes in front of them, whether there are gate lice.
All the time.
Yeah, whether there are gate lice that try to move in front of you at the airport to try to get your boarding
number.
number.
Up about two very different issues. I'll start with TSA pre-check.
Yes.
Start there.
Okay, go ahead.
The fact that Clear comes in front of you drives me nuts.
Absolutely ridiculous.
I just don't know why that's allowed.
I actually feel anger every single time, and I have to be honest that when fewer people are signing up for Clear, I think good. It's sort of pay for play, and that's
Sign
essentially
up for
what it
everything
is.
now and work out what the shorter line is.
That's exactly what AMH
The shorter line now is basically just the normal one.
I've actually noticed that.
Right?
You can actually see that. They give you actual wait times, and sometimes that is the case.
Ridiculous. Let's turn to the Middle East. Much more serious topic. Israel and Hezbollah reaching a deal for a 60-day ceasefire after weeks of mediated talks. Both the IDF and Hezbollah agreeing to withdraw from southern Lebanon. Bloomberg's Jemana Besechi, helping to lead our coverage out of the region, joined us now from Dubai. Jemana, welcome to the programme. What finally got this deal done?
Well, that is the big question that everyone's asking. And I would say there are a couple of factors that have been contributing. The first is, if you remember, about a month ago, Lebanon had actually indicated that they would be willing to agree to a ceasefire. And then the same day, actually, that we had that conversation with the Lebanon economy minister, an Israeli airstrike took out the leader of Hezbollah, Hassan Nasrallah. After that, the situation escalated a lot. But from the Lebanese part, there certainly was an element of war fatigue with the death toll count, mounting, more than 3,800 people killed, 1.2 million people displaced. But then you have to think about the broader regional picture as well. And this is the fact that Iran have been on the back foot. We're talking about their main proxy in the region, Hezbollah, being severely debilitated by the events over the last couple of months, with senior leadership being taken out. About 80% of their military capabilities, estimated by the IDF, also anticipated to have been eliminated as well. So they're on the back foot, not in a position of strength, not willing to sacrifice or make any further sacrifices with their main element of deterrence in the region. And therefore, you could say that this was the reason that they were actually forced to come to the table and would have applied pressure on Hezbollah on the Lebanese side to come to this ceasefire. On the Israeli side, you're also looking at war fatigue as well. Reports of the need to bring in more army recruits at a time when several fronts are going on. And also, you want to take into consideration that the terms of this truce is 60 days. That takes you 1 week after President Trump is going to assume office in January. So again, there's anticipation of a change in White House administration that I think would be weighing on both sides here. But I would just say also, this is a temporary truce, and the details of the truce are very reminiscent of a 1701 UN resolution that was put in place after the 2006 war. It was not implemented. So key here is going to be implementation.
The timing and implementation, both important. Jemana, I appreciate your time this morning. Thank you. Jemana Besechi there out of Dubai. Joining us now is Norman Rawl, the senior US intelligence official, I should say former senior US intelligence official. Norman Rawl joins us now. Norman, welcome to the programme, sir. I think an obvious question we're all asking is whether this makes it more or less likely we can see a ceasefire elsewhere in Gaza between Hamas and Israel. Do you think we can?
Good morning. These are two different areas. These are two different groups of decision makers. These are two different military environments. But for Hamas, the situation is weakening every day. Their leadership has been eradicated. Their military potential has been essentially destroyed. At the same time, they still remain hostages, to include 7 Americans, and they have some capacity to keep bleeding the Israelis. It comes down to the question of who is the decision maker right now within Hamas. And I think that's a troubling issue, because if it was difficult in the past to get decisions done between Doha and Gaza, imagine now where you have a fragmented leadership in itself. The U.S. will test this situation. And if you're Hamas, you have fewer allies now. Iran isn't there. Now is the time to go for diplomacy, because you survive and you can be rebuilt.
Norman, what will you be looking for over the next 60 days?
Well, this is likely, there's no such thing as a ceasefire that is perfect. We're going to see tests early on. The Israelis need to withdraw, and then we'll see how efficiently Lebanese armed forces replace them in these areas. We're going to see Lebanese Hezbollah continue to assert itself within Lebanon. There has been much discussion that maybe this is the time for the Lebanese government to finally demonstrate a capacity to run the entire country. I don't think it has that capability at present, but we'll see that in coming weeks. I think one of the drivers for Hezbollah to accept this deal was that it was being weakened to the point where perhaps its capacity to push back on the Lebanese government would be severely tested. So I think we're going to watch those dynamics.
Norm, let's say that this is coming to some sort of close. Let's hope that it is in terms of the conflict and the bloodshed. How different is the geopolitical order right now of this region than before October 7th?
It's a region in turmoil. It's the most contested. The region is more contested than at any time since 1945. No American administration has left office with the Middle East in such confusion. You have the proxies who remain alive in Gaza, Iraq, and Lebanon. The Houthis are more powerful than ever and can be replenished. Iran is on the back foot, but Iran has not been defeated. Iran just needs to come up with new tactics, new weapons. It needs to buy time to see how that's done. We do have some positive elements. The Saudis, the Emiratis are conducting a very revolutionary and very consequential economic transformations that involve artificial intelligence. This requires some very serious thinking about a U.S. approach to how we're going to work a really, really complicated minefield of issues.
So, Norm, what's your sense of what the Trump administration will do when it comes to their approach, what they're going to try to accomplish, and how this could look in, say, a year, how the sort of alliances are shifting?
I think we have some good sense of where this would be. The Trump administration will not want to be involved in a conventional war. The Trump administration will not allow Iran to test U.S. resolve, perhaps as aggressively as Iran and its proxies did under the current administration. The Trump administration will be more willing to tolerate aggressive Israeli action, but only if it ends a conflict in the short term. The Trump administration will continue to support the high-tech engagement with the Gulf states, who again are bringing in artificial intelligence to an extent never seen before. And the Trump administration will maintain energy discussions with the Gulf to ensure stability and price protection within the energy market as a whole. I don't think we're going to be looking for any dramatic changes in that environment. Of course, maximum pressure will return on Iran, but that will be a China discussion as much as an Iran discussion. And if that were to occur, although the Gulf is unlikely to participate in any actions that would lead to their exposure to Iranian missile or drone attacks, I'm confident they would support additional oil production to take advantage of any loss of Iranian production.
Norman, forgive me for putting you on the spot just a little bit and asking you some questions about mistakes that key personnel might have made over the last few years. But Jake Sullivan, Secretary Blinken, are there obvious mistakes the incoming administration you think need to learn from?
Diplomacy is difficult, and each administration prioritizes where it's going to put its attention. I think it's very important that we reestablish credibility as a deterrent actor in the region. It surprises me that the United States and NATO itself have not attempted to defeat the Houthi threat to the Red Sea. That's a situation that I don't think has occurred in modern times. And to give you an example, the multiple NATO ships are involved in Red Sea activity, and they're under fire. But during the NATO conference that took place in Washington, there was no significant discussion of a combat zone involving NATO navies on a critical artery for European trade and economic security. I think more attention needs to be devoted to that and to showing Iran there will be a powerful price paid for its aggressive activity and terrorism against the United States.
Norman, do you think that will change with the incoming administration?
Yes, but I think we need to recognize the administration will need time to pull itself together, and whatever plans they may have reminds me of the no doubt apocryphal story of a British prime minister who laid out his foreign policy objectives and plans and was then asked what might throw this off. And he said, events, dear boy, events.
There is also this question of the personnel, Norman, when we talk about who's going to be in these key ambassador roles. And the incoming administration is talking about sort of disrupting the old and getting rid of the deep state, as they've labeled it. How much is it important to have certain career diplomats in key positions to help with continuity? Or is it important to get new blood, new personnel in the region?
A new perspective is always important. It's critical. At the same time, you need experience to, in essence, explain very complicated environments that have a lot of history behind them. And in fairness, in the previous Trump administration, we saw Jared Kushner, who came into the area admitting that his background was limited, but he did draw upon the intelligence community. He worked with local diplomats, and they did achieve the Abraham Accords. So you need the blend of experience and new thinking. New thinkers are also iconoclasts, and that's important because people who have worked the Middle East for many years tend to say it's very tough, this is what we're doing, and we're going to keep doing the same thing for the next 100 years. And I know that frustrated the first Trump administration. So I'm a big believer in new blood relying upon people with long-term experience.
Norman, appreciate your time. We're thankful for you, sir, and your contributions this year. Have a wonderful Thanksgiving. Norman Roule there, the former senior U.S. intelligence official. The last point that he was making there, I think, is such an important one. Anne-Marie, of course, who's not here today, has talked about this repeatedly. Houthi rebels, all but shutting down a key trading channel for global trade, and yet we have done very little about it.
Yeah, this to me is actually one of the key questions. How much will this come under control in the near term? There was a real feeling that this disrupted freedom of the seas. You saw shipping routes that were extended, prolonging some of the length of time that things got shipped, as well as increasing the costs of those shipping routes. So you have to wonder, can we start to go back to the way it was before, or is this truly the new order of things?
How much will things change under President-elect Donald Trump? If you are just joining us, welcome to the programme. Equity futures right now on the S&P down by a little more than 0.1%. With an update on stories elsewhere this morning, here is your Bloomberg Brief. Global smartphone sales rebounding this year after 2 years of decline. An independent study by market tracker IDC showing Android-based rivals gaining ground in China and emerging markets, with iPhone volumes edging only 0.4% higher. Elsewhere, Volkswagen will end its activities in the western Chinese province of Xinjiang amid pressure from investors related to possible human rights abuses in the region. The company's local venture with domestic car maker SAIC will sell a small plant in the province to a state-owned company. And finally, German courier Delivery Hero boosting the size of its Middle Eastern unit's IPO to as much as $2 billion. Delivery Hero planning to sell a 20% stake in the company, with its market cap estimated at $10.2 billion. And that is your Bloomberg Brief. Up next on the programme, soaring costs, straining holiday shoppers.
Strong spending this year is expected, but the problem is we're on a knife's edge when it comes to wage growth versus inflation. As prices are going higher, wages aren't keeping up.
That conversation up next, live from New York. You're watching Bloomberg TV. Welcome to the programme. Equity futures just a little bit softer. We're down a little more than 0.1% on the S&P 500. Under surveillance this morning, soaring costs straining holiday shoppers.
Strong spending this year is expected, but the problem is we're on a knife's edge when it comes to wage growth versus inflation. As prices are going higher, wages aren't keeping up. We're in this purgatory, if you will, in terms of consumer balance sheets. They're getting by, but they're living paycheck to paycheck. They're not putting away savings at the same rate that they used to.
So here's the latest. Holiday shopping expected to break records this year, even as high prices continue to weigh on sentiment. Christina Boney of Moody's writing, we expect this season's holiday sales to grow a fairly anemic 1 to 3% in the United States, little better than last year's 3% growth, as consumers balance the wish to shop against ongoing high-cost essentials. Christina joins us now for more. Christina, welcome to the programme. Just looking through retail earnings over the last few weeks, we've had some bombs this quarter, Kohl's being one, Target being another. What's the takeaway for you so far this quarter?
Well, the takeaway is that the consumer is being very purposeful in their spending, and the consumer is suffering. There's really a tale of two consumers out there. You're seeing that low to middle income consumer under.
I think we've lost connection there with Christina Boney there of Moody's, and we're running out of time to re-establish that connection. So my apologies to the team over at Moody's. We'll try and figure that out for next time. But we have seen some bombs so far this quarter. One from Target, another being Kohl's, but we haven't seen bombs everywhere. And Walmart, just a reminder that some retailers are executing, some retailers are getting it done.
So to me, there's sort of this larger question over the earnings season so far this season, which is how much are we just witnessing the cannibalization of market share by Walmart on all of the other retailers? It's not just that higher income shoppers are downshifting to Walmart. Walmart is actively catering to that clientele. They are increasing their inventories of higher-end electronics, of higher-end retail goods. Their online consumer platforms are selling shoes, some of the big sneakers. So you start looking at this and you start wondering, how do you gauge this from a macroeconomic perspective when there are some very specific industry trends that are going on?
Let's talk about one trend, interest rates. Interest rates might not be coming down. I remember in corporate credit for a while when we were talking around this table about surviving until 2025. And the hope was that interest rates would be down somewhere near 3.5% by the time we get to the end of next year, maybe even lower. And let's be clear, there are some banks who still predict that might happen. But Deutsche Bank's Matt Lazzetti, I think, just introduces a brand new risk. For the consumer, at least, interest rates aren't coming down. If you believe Matt Lazzetti and Deutsche Bank, they're not coming down. The Fed's going to be on pause for 2025. Now, that is largely because the backdrop for growth is going to be better, and we'll see policies that might encourage growth, and that might come with a little bit more inflation. But there are some consumers right now that need lower interest rates, some borrowers that need lower interest rates. They may not get them.
And this, to me, is the reason why Neela Richardson was so astute yesterday when she was talking about this knife's edge. Because on one hand, borrowers, companies that actually employ a lot of these people need lower borrowing costs. At the same time, should the Fed lower borrowing costs too much and inflation picks back up again, that destroys the buying power even more of these consumers. So it's just kind of this push-pull right now that you can feel. And you can feel that anxiety among Fed officials that had a very nuanced message, frankly, muddied message in their meeting minutes, because it's really difficult to know what the bigger risk is right now.
Each meeting for Chairman Powell is going to get harder and harder over the next several months. December will be complex. I think the March meeting, when they come out and forecast for March, it's going to be so difficult. By then, you're actually going to see real policy changes. You might have a better idea of the appetite for deficit spending down in Washington as well. Set some policy around that.
You might also have a sense of the appetite to disrupt business as usual at the Federal Reserve and some of the shadow Fed policy.
Might have a new Fed chair.
Exactly. I mean, there are a lot of potential question marks that are arising early next year.
Up next on the programme, in the second hour of Bloomberg Surveillance, we'll catch up with Matt Miskin of John Hancock, Isaac Boltansky of BTIG, Michael Swanson of Wells Fargo, and the former New York Fed President, Bill Dudley. That's all coming up from New York. This is Bloomberg.
I don't think we can look at the consumer through a monolithic lens.
The consumer's really looking for somebody who's going to provide them the ability to stretch their dollar and stretch their wallet.
The consumer is very sensitive to price.
We're in this purgatory, if you will, in terms of consumer balance sheets. They're getting by, but they're living paycheck to paycheck.
It's been weak. I mean, the consumer has been softer.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
For many of you, closing out the month of November today on the S&P 500 so far this month, up around 5%, the best month of gains potentially for the year so far. And over the last week, adding some weight to that rally, 7 days of gains on the S&P 500. Equity futures so far this morning negative by 0.1%. On the Nasdaq 100, we're down by 0.3. In 90 minutes from now, Lisa, tons of economic data, jobless claims, PCE, and another read on GDP.
Yeah, you basically nailed it when you were saying they're trying to cram everything in before everybody goes away, and we're trying to make it so that everyone gets a 4-day weekend next year and the year after, because why does anyone come in on Friday? Why isn't that also included in the U.S. holiday? But I digress. I will just say PCE, we cannot underscore enough how important it is for this PCE print to come in at expectations or below it for this Fed to go 25 basis points next month, because ultimately they have said they are data dependent, bordering on data point dependency. I don't want to put words in anyone's mouth. That's not what they're saying. But it feels like that is the gap between potentially moving and potentially not.
They're going to be policy dependent too, in a big way for 2025 and beyond. And we know the individuals that might be in control of the levers of policy through the next 4 years or so. President-elect Donald Trump naming the economic lineup now. We've got a fuller picture. Kevin Hassett at NEC, Jamieson Greer over at USTR, Scott Besson, as you know, Treasury Secretary Designate, Commerce Secretary Designate, Howard Lutnick. That's your team. They're the big four.
Yeah, and the reason why it has been confusing to get a cohesive message from the team that has been named is because they don't totally correlate when it comes to sort of a unified vision. It feels a little bit like there are going to be some pretty big arguments among some of these individuals when it comes to how much pain the U.S. is going to accept in return for, as Jamieson Greer, the named U.S. trade rep potentially, has called the decoupling from China. It's just unclear how this is going to shake out, which is a reason why markets haven't been taking it seriously. Nonetheless, it is clear on 3 fronts. This is a president that cares about markets, Scott Bessent. This is a president that is serious about potentially increasing the tariffs and increasing the gap between China and the U.S. And tariffs are very real and very much going to be implemented. And this is someone who also really cares about immigration and really cares about maybe making a point on a couple of things that he thinks have gone wrong since he left office.
We touched on this earlier this morning. There's one name missing. It's Kevin Walsh. And I still think Kevin Walsh is in the picture. And I just wonder at what point they start to think about naming the next Federal Reserve chair. Because it sure as hell won't be Chairman Jay Powell. And if it is Kevin Walsh, how quickly do they pull the trigger on that?
Kevin Walsh is a hawk. He wants to keep rates higher to keep inflation lower. That runs exactly opposite to this president's goal, which is basically to get interest rates lower, to get Wall Street really running again. It's just hard to bring this all together. It's hard to understand how this is going to work. And maybe the devil is in the cats in the bag that are going to hash it out and somehow something's going to come from it. But it's the reason why people aren't taking it too seriously, except for in small pockets, because how do you game this one out? This is game theory that will twist a mind.
It's why the V word makes an appearance in every single outlook I've read so far. Volatility for 2025. Equity futures right now on the S&P down about 0.1%. Coming up this hour, we'll speak to Matt Miskin of John Hancock as U.S. stocks mark another record high. Michael Swanson of the Wells Fargo Institute on food inflation ahead of Thanksgiving. And former New York Fed President Bill Dudley on the biggest challenges facing Donald Trump's Treasury pick. We begin this hour with stocks coming off all-time highs, notching the 52nd record so far this year. Matt Miskin of John Hancock saying this: the market's muscle memory from the end of 2016 has been driving cross-asset performance. The market regime has gone into full risk-on mode. Our positioning calls continue to be for a quality at a reasonable price approach to U.S. equities and overweights to U.S. large and mid-caps. Matt joins us now for more. Matt, welcome back to the programme, sir. I'll start this hour the way we started the previous hour, which is we had the tariff threats and then stocks closed at a record. Matt, what do you take away from that?
Don, I think it goes back to the muscle memory of 2016, and we're really still in the honeymoon phase of this new administration, where a lot of the more beneficial policies are looked at, deregulation. You're seeing small caps do well, but you're not seeing any of the negative elements of the potential administration be influencing the markets. Into next year, if you follow the same 2016 to 17 parallel, 17 becomes more about fundamentals. So we remove kind of the political influences as much, and we go back to what is the economy doing? What is earnings doing? So on and so forth. So for now, we would fade some of the recent price action. We think we're in the 6th inning of the 9 innings of kind of this repricing. But really, at the end of the day, the best fundamentals are still in U.S. large caps. The cheaper stocks with high quality attributes are still in U.S. mid caps. And those continue to be our highest conviction calls.
So, Matt, let's talk about small caps. You did mention them, but not your highest conviction call. Small caps in November 2016, up double digits. November 2024, up double digits. Is there any reason to believe this continues?
So regional banks are the biggest driver, and really it's that deregulation theme. In 2016, the earnings revisions for small caps were already improving, and they actually rose into 2017. So there was a fundamental story in 2016 and 2017. We were just checking these stats. S&P 600 small cap index, the earnings revisions are hooking down. Earnings growth for Q3 for U.S. small caps were down -9% for the Russell 2000, while the S&P 500 earnings are up 6%. So there isn't the fundamental backdrop yet. Yes, you can get the multiple re-rating. S&P 600 PE ratios reached 20 times back in 2016 off that massive move higher. We're already seeing a huge rise in the multiple in the S&P 600, but 20 times is going to be harder to do. The biggest difference between now and 2016, rates are a lot higher. And back, just the last couple of years, that small cap trade ran into a higher rate environment and actually started to see headwinds. We wouldn't be surprised if that's what we see in the near term here.
Matt, you said we're in the 6th inning of repricing in a 9-inning repricing. Can you paint us a story of what game we're playing, of what it looks like, where we're heading? I mean, I don't even know what the inning looks like at the end of the 9th. Are we talking about recession? Are we talking about the roaring 20s?
Yeah, it's just really short term here, Lisa, in terms of the muscle memory of the market going back to 16 and to 17. This is a 3-month window, really. That's how quick this was in terms of the administration repricing of the equity market. And really, it's the same exact playbook. It's almost kind of scary how closely it's been. But again, it's short term, and then it's the broader trends of the market. It's the more secular trends, whether it's earnings, innovation, the macroeconomic backdrop. And so that's really, we're kind of saying, look, if you're going to try to be tactical here, really short term in terms of trading this, just realize it's already been a big move. We might get a little bit more, but after that, we would fade it. And into next year, we actually see disinflation. We see a bit weaker growth. We see earnings growth that isn't going to hit the bar of 15% next year. We see elevated equities and elevated bond yields. So you put all that together, we're tilting a bit more conservative. We're getting enough on the ball with the U.S. equity overweight that we have. But it might be a year of a comeback trade in terms of bonds and some more defensive parts of the equity market.
So, Matt, let's do some near-term scenario analysis. Let's say PCE comes out at 8:30 today in about 90 minutes time, a little less than that, and it comes in at 0.4%, which is a bit more than is currently expected. Bonds sell off. You see the short end spike higher in terms of yields. You're in there buying aggressively. Is that correct?
Yeah, we take up the backup in bond yields as an opportunity. To your point earlier, Lisa, I mean, the Fed did not help us a lot with those minutes yesterday. They are just saying, look, December, it's a coin flip. We'll see what happens. And so these data points, like you said, everything's going to be hypersensitive for that December cut or just hold. In our view, though, we could see a re-inverting of the curve, a flattening in essence, where the 2-year comes up because it's not pricing in as many cuts, and then the 10-year actually falls because now the Fed isn't going to be the put anymore. The market's like, okay, you had the Fed put, and then now you have the fiscal put. In our view, the Fed put is going to be coming off. The market's thinking that's the fiscal put. Even that, I think, is actually a bit of a leap of faith, but at the end of the day, the Fed might not be cutting in December. We actually think the more intermediate part of the curve could actually rally on it.
So what's interesting to me, Matt, is that even though Fed officials don't seem to have any conviction, you do have conviction in this disinflation, even at a time where the data has been confusing in and of itself. We got U.S. consumer confidence yesterday rising to the highest in 16 months, at the same time that U.S. new home sales fell to the lowest since November of 2022. Where are you getting that confidence about disinflation?
Well, so at the end of the day, it's all about housing. And you just, spoke to new house sales really dropping off a cliff, but housing prices have been moderating. And we're starting to see a change in the housing dynamics where inventory is starting to rise. And a lot of it is in the hot spots of the country that really saw the biggest house price appreciation. So Florida, Texas, Colorado, other hot spots that saw a huge influx of people and housing price appreciation, that's starting to come off. 2/3 of the inflation dynamic has been housing or shelter, owner's equivalent rent. If you take that out, inflation right now is 1.3%. CPI ex shelter is 1.3% year over year. So it's really coming down to housing. Mortgage rates just went back up recently, so that's actually probably going to weigh on it. And then other things, stronger dollar, that's disinflation. We're buying stuff abroad at a with a stronger dollar. That means a lower price abroad. That's good. We actually see weaker oil prices. If we're going to increase production, that's going to be increasing oil supply. That decreases gas prices likely. That's disinflationary. There's actually more disinflationary forces than the market thinks right now. And that's, again, why we look at this backup in bond yields as an opportunity for high quality investors.
Matt, just before you go, doing a quick survey throughout this morning so far, just how credible a threat the tariff threat actually was in the last 24, 48 hours. The additional 10% tariff on imports from China, the 25% on products from Mexico and Canada. Do you believe the president-elect would actually go through with that?
It usually starts as a negotiation tactic. I mean, again, we're using the playbook of the last term in terms of 16 into 17. And really, this is not new. This isn't our first rodeo here as it relates to tariff talk. But we do have to be careful. The last sample was in that 16, 17, 18, 19 period. And really what happened was inflation averaged 1.6%. It didn't create as much inflation because it actually decreased demand and it created a bit weaker real GDP growth. So there could be a period that could be a little bit more nominal, but a little bit weaker real, and a little bit weaker real GDP growth would actually cause disinflation in our view because the consumer is going to balk at that higher price. So there's a lot of cross currents, and we don't know policy yet. At the end of the day, we're focusing on the fundamentals.
Matt, thank you, sir. Matt Miskin there of John Hancock, echoing what I saw from Max Kentner of HSBC as well. Look at the backdrop and not the politics. I think it's interesting, though, just to hear from a range of guests so far, Lisa. Do they believe it's credible or not? It certainly doesn't matter what we think. It matters what market participants think, because they're the people that have got to buy these things. And ultimately, what I hear is negotiation. That's all we've heard repeatedly so far this morning. I think you put certain stocks in the penalty box, GM being one of them, certain currencies in the penalty box. SocGen's Kit Juice came out yesterday, said he did not want to pick up the pieces with the Canadian currency. But then for the broader market, there seems to be this comfort with the idea that this is the start of a negotiation, that what you heard in the last few days probably won't translate to reality.
And in fairness, as we were just hearing from Matt, this isn't the first rodeo. This market has dealt with this before. They've dealt and been benumbed by headline after headline. It's 3 weeks from the election. He hasn't taken office yet. I understand why people maybe aren't responding to what the ramifications are this prematurely.
We'll see if it's the right way of looking at things in about 2 months' time. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Delegates telling Bloomberg that OPEC Plus is discussing another delay in increasing oil output. Ministers meeting this weekend, facing slowing demand in China and rising supplies in America. Elsewhere, shares of Hello Kitty parent Sanrio tumbling the most since 2014. The company saying major shareholders are reducing their stakes. The company saying in a statement shareholders will let go of as many as 26 million shares at a price to be determined later. And finally, the LA Dodgers signing two-time Cy Young Award-winning pitcher Blake Snell to a 5-year contract worth $182 million. The deal positions the World Series champs to defend their title with an already star-studded roster.
Yeah, well, I'm actually less interested in that than the Hello Kitty story. I've got to be honest. I'm sorry. I've tried the sport. Actually,
okay, well, do Hello Kitty if you want.
Yeah, I want to do Hello Kitty.
What's the deal? What's it about?
You never engaged with Hello Kitty?
No, I have, of course.
Yeah, so did you ever
not personally engaged with the product. Am I aware of the product?
Yeah, you're aware of the product. You never had like the pencil kits with Hello Kitty and the sort of cute little notepads that were the Hello Kitty shape?
That wasn't what I reached for on the shelf when I was a child, no.
Yeah, I actually did. And honestly, I'm surprised.
Too.
Yeah,
I'm obsessed with it.
I don't know. I was more sort of into that. But the Dodgers continue to dominate, and that's sort of the story of the
I remember AMH went to Tokyo a number of years ago and was absolutely obsessed with that store.
Yes, well, she's not the only one, although evidently maybe a little less.
It's why she's not here. She's so upset about what's happening with the stock. Up next on the program, the Trump agenda taking shape.
The election, it's three stages. It's the initial risk-on reaction to the election. Then you have what we're in now, which is nominees and policy proposals. Then you have phase three, which is probably next year, which is actually policy implementation.
We'll talk about the last piece of that up next on the program from New York. This is Bloomberg. Equity futures on the S&P, no drama here. We're down by about 0.1% on the S&P 500. Rally in the bond market. Yields are lower by 4 basis points. The 10-year 426.53. Under surveillance this morning, the Trump agenda taking shape.
The election, it's three stages. It's the initial risk-on reaction to the election. Then you have what we're in now, which is nominees and policy proposals. Then you have phase three, which is probably next year, which is actually policy implementation. U.S. markets I think are still benefiting from like the risk-on repositioning part. If there's one thing that a Trump administration is probably focused on is domestic growth.
So here's the latest this morning. President-elect Donald Trump's economic team coming together, adding shape to future policy proposals. Isaac Boltansky of BTIG highlighting this is year 5 of Trump, not year 1, writing Trump is moving quickly and avoiding some of the potholes that slowed and narrowed his first administration's policy agenda. Isaac joins us now for more. Isaac, good morning to you, sir. I want to pick up on that phrase from Stuart Kaiser, who you just heard from. Policy implementation. Donald Trump, president-elect, is moving very, very quickly. Isaac, how quickly will Congress move in the coming months?
I think that there is an undeniable sense of urgency on the Hill. And when you talk to congressional Republicans, I think they realize that they have an opportunity here to, A, capitalize on the momentum from the election, but B, they have a wafer-thin majority in the House. And I think that they want to move as quickly as possible because they know it's going to be difficult over time to keep that majority together.
That speed, you've talked about a very aggressive timeline in the past. Let's talk about size. What's your idea of how big the appetite is for deficit spending on the Hill?
Look, this is the question that I think everyone in D.C. is having right now is how much will Republicans put into these budget reconciliation instructions? What number are they looking to in terms of deficits? And I think it's noteworthy that the chairman of the Senate Finance Committee has said he doesn't think that we, quote unquote, need to pay for extending the Tax Cuts and Jobs Act, which is $5 trillion. There's still some in that caucus who believe that the whole thing should be paid for, but I think we are going to see a very permissive GOP caucus who is willing to spend anywhere from $5 to $7.5 trillion in deficit finance cuts over the next decade. That's where I think we are right now, given that ultimately their goal is to get something done. And you're starting with a price tag of $5 trillion. That's where we're starting.
Isaac, you said that it's important for this administration to move quickly. Markets seem to be working out exactly what the priorities are, and some of the appointments seem to be at cross odds with each other in terms of what they prioritize. How much infighting is there going to be among the cabinet that we just mentioned?
I mean, if we just look at the economic team, I mean, look, they're pragmatic, and I think that's positive, but I mean, we look at these 4 pictures and we think about it ideologically, it's a bit cacophonous, and I think that there's a good chance that it's going to be contentious. I think that we're going to have a lot of noise coming from commentary from each of these different camps that run a counter to one another. But Lisa, I also feel as though the president yesterday chose that time, that moment to announce these tariffs, in part because he wanted to say, you know, here, hold my Diet Coke. I'm going to show you who's still in charge of the economy. And my aides are here to aid me. And I am ultimately the decider of these economic policies. And I think the timing there was noteworthy for that reason.
Which is the reason why you saw a slight move, at least in currencies, but no recognition in equity markets, aside from a couple of pockets, as we've talked about. There is a question, though, if it's a little bit more than that, especially with Jamieson Greer being named to be the potential U.S. trade representative. He's the protege of Robert Lighthizer and talks about a decoupling from China, regardless of the potential pain near term to the U.S. economy. How does that pair with some of the other economic policymakers that are in place? Kevin Hassett, we know, has been a big supporter of tariffs. But what about Scott Bessent, who has been what some people believed was the moderating force, which maybe is what you're saying Donald Trump was responding to say, hold my Diet Coke, not so much?
Yeah, look, I think that we have to go through and understand some of the processes here and some of the political motivations. And on the process here, I think it's meaningful to me that it appears as though President Trump is embracing his power under IEEPA, the International Emergency Economic Powers Act. That lets him act on day one on some of these tariffs, whereas there will be an effort under Section 301, which takes longer. Takes 6, 7, 8 months to go through the process. So we've got to understand that these are dual tracking at the same time. I think, Lisa, that ultimately what we should take away from yesterday is in order to prove that something is a negotiating tactic, you still have to demonstrate a willingness to go through with that threat. And for me, I think that the president is going to go through with his threat on the Chinese tariffs. I think that is the low-hanging fruit. There's political backing for it on both sides of the aisle. And I think that that is something that we are going to see on day one. I do not think that we're going to see the across-the-board tariffs on Mexico and Canada, at least at the start, in part because I think there are clear concessions that can be made to demonstrate that they're willing to negotiate, which is what the president wants as he, re-enters the Oval Office.
As we game theory out trade negotiations and what's going to happen with tariffs, there has been a very clear message sent in healthcare, and I don't want to ignore that because you've seen the real response in healthcare stocks. The fact that one person after another is either a vaccine skeptic or somebody who really pushed back against some of the masking procedures. I'm thinking of Jay Bhattacharya, who was just named to be the director of the National Institutes of Health. I'm just wondering, Isaac, how much of a wrecking ball do you think is going to be taken to the healthcare industry? How much change can you expect to see?
Look, I think that there are a number of acute areas where you're going to see meaningful changes, things like skilled nursing facilities, health savings accounts. I think those are areas where you could see meaningful shifts. In terms of what we see at the alphabet soup in healthcare, the FDA, the CMS, the NIH, I think my main takeaway and what I've told clients so far is I do think that there's going to be a fair amount of natural attrition at these entities. The FDA in particular. And I think that in turn is going to have an impact on things like approval timelines for drugs and medical devices and other things within there. I think that that's a concern for me, is that we are going to see a movement of rhetoric at the top, which I think is going to lead to some attrition in the staffing levels, which pushes out timelines. I think that's the one thing that when you survey the waterfront hasn't been accounted for in the market yet.
Isaac, is that McKinsey for a lot of people are going to resign?
Yeah, it is exactly that. Yes, I think that I think there's going to be a return to the office executive order from the White House on day one or maybe day two. And part of that is meant, I think, to catalyze some natural attrition and resignations in the federal workforce. That is part of the strategy here, is to shrink the federal workforce. And there are big fights that are going to have to be run through the courts on things like Schedule F. But there's a hope within Team Trump that if you say, all right, you've got to come back to the office 5 days a week, that you're going to have those resignations that follow.
Isaac, it's good to see you. Have a happy Thanksgiving, sir. Thank you. Isaac Boltansky there of BTIG. We've seen this at the corporate level. We're about to see it maybe at the government level.
That said, the people who voluntarily quit, are those the people who you want to lose? I mean, you have to think, is that really the game plan? Is just sort of, let's see how many people will quit and then we've shrunk the government? Or is there going to be a more systematic way of understanding which people you want to keep and which people you want to quit?
I said this earlier this week. We're going to find out.
Yeah.
Because this is an objective. Coming up on the programme, Michael Swanson of Wells Fargo on food inflation as Americans prep for Thanksgiving. From New York, this is Bloomberg. Two hours away from the cash open, equity futures down by 0.1% on the S&P 500. Back with some outperformance on the Russell. There we are. Small caps up by 0.75% with your morning movers. Here's Matus. Good morning, Matus.
Jonathan, good morning. Those small caps are resplendent. Dell is not. The theory was Microsoft Windows, new refresh, and you zoom out there and pick up your new PC. You didn't. The refresh cycle for the individual is lagging. They're not convinced on the AI that they need the refresh now. They're pushing it out into 2025. The revenue for the PC side of the business dipped 1% to $12.1 billion. On the AI side, yes, corporates are spending large and lumpy. AI servers, Citi say, was a lumpy AI revenue. Orders hit a record of $3.6 billion, and the pipeline is strong. You have a disconnect between what you and I might think we need and what the corporates believe that they need to move forward. By the way, Morgan Stanley say this is overdone. Now's your chance to buy. It's overdone on the reaction. At the same time, you look at Hewlett-Packard. This is the biggest drop that we've seen since August 2023. Again, a miss on the PC side of the business, just 2% short of the estimates. But it is about the guidance. The fiscal first quarter, they're going to be like 70 to 76 cents. That is way wide of the mark at 86 cents. The issue here is component costs are rising, and that is a warning shot in terms of the supply chain into tech. I'll leave you with a snapshot of CrowdStrike. Remember the 8.5 million Microsoft users that went dark in the summertime? Well, they have recovered from that. They made over $1 billion in this quarter. So let's not be disingenuous. In the third quarter, they made over $1 billion, and they've raised their guidance for the year. But why are we lower? It's to do, again, with a slippage on the guidance. They're going to make 84 to 86 cents. The market was looking for 86 cents. The slightest fissure in your guidance is ruinous. Bank of America, I like the line. The glass is also half full. They've got a target of up to $400 from $365. Glass half full for Thanksgiving. Jonathan, good morning.
Manus Crowley, a happy Thanksgiving, sir. Appreciate your time. Thank you. Under surveillance this morning, President-elect Donald Trump rounding out his economic team, naming Kevin Hassett as NEC director and Jamieson Greer as U.S. Trade Representative. Hassett will likely lead Trump's tax policy, with Greer focusing on expansive trade and tariff agendas. I spoke to Anne-Marie, who helped lead some of the reporting on all of these picks. And what do we need to know about Greer? And the answer was a mini Lighthiter. That seems to be the takeaway from lots of people.
Well, he was the protege of that trade negotiator or hardliner on China. Some of his previous commentary, I think it's worth repeating. There is no silver bullet talking about the generational challenge with China. However, the cost of doing nothing or underestimating the threat posed by China is far greater than taking a hardline now and suffering the potential pain near term. It just raises a question how much infighting there's going to be between him, say, and a Scott Bessent that wants to massage the message a little bit to markets. In the meantime, markets are just ignoring it all and saying it's going to be fine. It's just a negotiation.
Unless you're a shareholder of GM and some other select names. General Motors got hammered in yesterday's session.
In large part because Mexico is being targeted. And I think that this really does raise the specter of supply chains that already have gotten rejiggered in response to the potential decoupling of the U.S. and China being upended once again, and how these companies deal with it, especially with the added bonus or detraction of the fact that Elon Musk has the ear of the president and Elon Musk is a direct competitor. So a whole host of issues here at play.
The breakdown of imports from China into Mexico are fascinating. I've got some of the numbers that I've shared with you previously. Product from China commands 1/5 of all Mexican imports. Some 70% of those goods go to only 50 firms. Only 50 companies. And a good chunk of those 50 companies are American companies in aerospace and in automaking.
Which is a reason why President-elect Donald Trump has talked about Mexico essentially being a backdoor for Chinese imports into the United States. And it's the reason why we saw Mexico saying to China, maybe hold off on the BYD factory because it kind of makes us look bad. In the meantime, Mexico is saying, all right, you really tariff us, we'll tariff you. And Canada is saying, how did we get roped into this? Why are we involved in any way, shape or form?
Because Canada and Trudeau, you know, like, why not? I don't think those two see eye to eye. I think that's quite personal.
So evidently that's going to be a thing. But this, to me, it really is the Mexico threat, especially with how much people have moved production.
Yeah, and I think you could find some common ground in Mexico. Your point about BYD, Mexico has been upfront about this. They want to also reduce dependence on China as well. I think this is something they want to do too.
Yeah, although when I was down in Peru, there is this feeling among a lot of manufacturers in South and Central America that, you know, ultimately they would rather have a close relationship with the United States and, frankly, even with Europe. But money is money. And China is pouring a ton of it into this region, and they're trying to take over market share in the backyard of the United States. So it sort of puts them between a rock and a hard place, especially if there's a real lack of clarity in terms of U.S. policy.
I'm pleased you brought that up. Just as an example, I think China's helping countries build railroads and the United States are giving them second-hand trains. I mean, there's a big difference.
Yeah, I mean, China right now has just built, one of the biggest ports, one of the most modernized ports in South America, in Peru, and opened it up saying this is going to reduce shipping times to China. Are they supposed to say, no, thank you, we don't need it, when actually, maybe they do?
If you're going to have an isolationist America, who's going to fill the void? And at the moment, in certain places of the world, key places around the world, China's been doing that for a while.
Which is the interesting thing, and I think it's important to point out, we haven't talked about that, just Jamieson Greer has talked about subsidizing industries in the United States to try to offset some of the pain to this sort of isolationist policy. Again, a lot of these policies run counter to each other, and it really is going to be a cat's in the bag, maybe.
We're seeing some big shifts, that's for sure, already. And I think it's worth repeating, Lisa has already this morning. It's only 3 weeks yesterday that we had the election in America, and already things are moving so fast. Israel and Hezbollah agreeing to a 60-day ceasefire after weeks of talks led by US mediators. Egypt, Qatar and Turkey are expected to join the US in a new push for a ceasefire between Israel and Hamas in Gaza. Another example of things moving pretty quickly.
Yeah, although it is different to see whether we get something between Gaza and Israel. It's a very complicated situation in terms of who fills that vacuum of power and a whole host of other questions. That said, you are correct. Norman Roule came on this show about an hour ago and said that essentially this is a completely reordered region. You're looking at a region that is more in flux than in the late 1940s when it comes to where power lies. And that is what this new administration is going to be walking into.
Big takeaway from Norman earlier this morning. If you missed that conversation, the incoming administration needs to re-establish deterrence in the region. And he was targeting the story specifically around Houthi rebels and the Red Sea.
So it sort of goes to this point that there needs to be a ratcheting up in tensions. That's the reason why volatility keeps coming up again and again, because people don't believe you if you don't show that you're serious. And that, I think, is what we are probably going to be seeing.
Need to get to this story as well. Mentioned it a little bit earlier this morning. Global smartphone sales rebounding this year after 2 years of declines, but Apple continuing to miss out. An independent study by market tracker IDC showing Android-based rivals gaining ground in China and emerging markets, with iPhone volumes edging only 0.4% higher. There's a struggle over at Apple.
Yeah, and this is an issue globally, but in particular in China, where local brands are very much cannibalizing from them. This highlights why it's important for them to really get on board and, frankly, get ahead of the AI trend and convince Jonathan Farrow why it's important to have a personal assistant on your phone when your battery dies in the middle of the night and then you can't sleep because then suddenly you worry about waking up.
Thank you. That was last night. It turned out it was 12:45.
That's horrible.
When I went into the living room and checked my watch.
Oh, that's horrible. I'm so sorry.
12:45.
A new phone?
Then had to wait for the phone to recharge. Obviously was getting a little bit paranoid about that, just in case the alarm doesn't go off. And I don't even wake up to the alarm because my sleep anxiety is that bad.
Okay, so are you going to get a phone?
The things I do for this program.
So do you get a new phone?
Sleep deprivation. No, I just need to go old school. Just get the old school alarm. Just have that clock sitting there that makes that massive noise. Wake up the whole apartment. That'll go down well. Let's turn to Thanksgiving. Shoppers may struggle to find deals at a grocery store this holiday season. Wells Fargo's chief agricultural economist, Michael Swanson, writing, although food inflation continues to slow, budgeting for Thanksgiving might be challenging for consumers still acclimating to historic food price increases. Michael joins us now for more. Michael, what a special conversation we can have with you, sir. Let's talk about how expensive this Thanksgiving dinner is going to be compared to last year, the year before, and the year before that.
Well, nothing lights up a comment board like putting out a budget for Thanksgiving because nobody believes you. So, we pulled all the data from the Nielsen scan and looked at the average price for, what we put together was an average budget. So $90 from name brand, $73 for going private label. But that's up, actually down 0.5% for the national brand and up 2.7% for the store brand. So kind of an interesting dynamic going on.
So, Michael, are you suggesting that you can save money on name brands this year?
Yes, you can. The whole point in some categories is they're actually offering you, quote unquote, the premium of the name and a savings. Like in cranberries, there's a couple of very prominent cooperatives out there that are very aggressive on their pricing.
Is there a particular region that's driving this? Is it because the agricultural backdrop means that there have been more cranberries produced, more turkeys raised, fewer pardoned? What's sort of driving the fact that we aren't seeing more inflation?
About 85% of food pricing comes beyond the farm. So it's only 15% at farm level, according to the USDA dollar analysis. So it's about the labor. what we're seeing is the supply chain's healed. We've seen transportation costs come down a little bit with some of the diesel pricing and competition. You certainly cover the markets well, and you know that Walmart and Target and the rest of them are just beating each other up, trying to get one more shopping trip out of you each week if they can get it.
The one takeaway that I got from some of your analysis, Michael, was that essentially you're going to have a relatively benign inflationary backdrop for your Thanksgiving dinner as long as you don't drink. If you want to actually have spirits of any sort, well, forget it. That kind of goes out the window. Is that your takeaway, too, that basically alcohol inflation has continued to outpace everything else?
It has. But once again, you look at that ecosystem of what you could drink, from ultra premium wines to more affordable wines. You could set your budget very differently. I mean, that's a wild card. That's why we did not want to put that into the budget, because if you want to get a lot of commentary, just use a wine brand and have everybody criticize you for it.
Michael, let's put coffee in the budget. Let's say Lisa drinks lots over the next few days, which is quite likely. And then the following morning wants a strong cup of coffee. I'm seeing this headline on the Bloomberg terminal this morning. Arabica coffee futures extending the rally, hitting the highest level since 1977. Michael, what's going on with coffee?
Once again, it speaks to the whole thing about, labor costs throughout the supply chain. I'm pretty much going to assure you at the farm level, they're not making a ton of money, even with today's coffee prices. Most of what we see is really talking to that labor component and the transportation that's been so prevalent in the last couple of years.
That is getting more expensive for sure. Michael, appreciate your time, sir. Have a wonderful Thanksgiving with the family. Michael Swanson there of the Wells Fargo Agri-Food Institute.
All I could say is that's so unfair. Honestly, you're in a tryptophan-induced coma. You're feeling just like you can't have another conversation about whatever your grand uncle has to say, and suddenly no coffee because it was too expensive. It's just not fair. That's all I could say.
And it's not just the year-over-year comps, as we know. It's the last 4 years. It's the cumulative inflation of the last 4 years. And what Michael said about consumers still struggling to acclimate to what's been happening, it's really that. The marker is the last 4 or 5 years. It's not the last 12 months.
Yeah, and this is what we've seen again and again, and the reason why consumer sentiment has gone down. There's this theory in economics that it takes a number of years for people to feel like they're not being left behind, as well as real wage gains. And we haven't gotten to that point yet, or we're just getting to that point, which is why Neil Richardson was saying it's getting fragile. Does everybody make the same thing? Does anybody mix it up? I mean, does anyone like turkey?
What do you mean? Like have a different dish?
Yeah, I don't know.
Like a beef bourguignon or something like that?
Actually, that's something
we did that one year.
Yeah, well, I mean, in our house, there isn't this desire to make turkey, so there's always a discussion. How far astray do we go?
I did it with TK a few times. I think you attended one, actually, a number of years ago. Yeah, you showed up at the end of it. You missed out on all the food, which might have been wise, because Tom turned up with a smoked turkey. That used to be his thing.
Yeah, I remember that. That was
which
good.
He got from Jerome Schneider of PIMCO. That was the strong suggestion, well, the smoked turkey.
It was actually lovely. It was just a little chaotic, so I don't really remember the food part, because there was a lot of stuff going on.
It's a lot of chaos, as you can imagine, over at TK's. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. President-elect Donald Trump tapping private investor John Phelan as Secretary of the Navy and picking Jay Bhattacharya to lead the National Institute of Health. Bhattacharya is a Stanford professor who called COVID lockdowns the biggest public health mistake we've ever made. Elsewhere, shares of CrowdStrike trading lower, the cybersecurity software firm issuing an earnings forecast that fell short of expectations. The report is the company's second since a flawed update crashed millions of devices operating on Microsoft's Windows systems earlier this summer. And finally, a record number of people are expected to travel this holiday weekend. AAA is expecting nearly 80 million people to travel 50 miles or more between yesterday and this coming Monday. That is 1.7 million more than travelled last year, and I believe Lisa is going to be one of them.
Not far, just a couple hours. But I've learned from
50 miles plus.
Yeah, well, I count as the 50 miles plus, and I understand it. It's just that, do you get road rage?
Do I get road rage?
Do you ever
Bramo, this is live TV. It's not a therapy session, but if you want to do this, we can.
No, let's move on.
Talk to me.
No. It's just sort of.
What happens when you're driving?
Everything feels like infinitely longer when there's traffic. The stop and go can make something seem a lot longer. Let's move on. Happy
do you
Thanksgiving.
find yourself sometimes losing control?
I never lose control. I'm always a perfectly oiled machine, John. You know that.
Up next on the programme, Scott Bessent's Biggest Challenge.
The equity side has been very excited about Trump ever since the win, but this is good news for the bond market. The Secretary of Treasury to come is concerned about the deficit, so that's welcome news.
That conversation up next, live from New York. You're watching Bloomberg TV. Equity futures on the S&P 500 just a little bit softer. We're down 0.1%. In the bond market, yields are lower by 5 basis points, 425.76, and the euro bouncing back to 105.33. Under surveillance this morning, Scott Bessent's biggest challenge.
The equity side has been very excited about Trump ever since the win, but this is good news for the bond market. The Secretary of Treasury to come is concerned about the deficit, so that's welcome news.
The new Treasury Secretary, if confirmed, is likely to be focused on fiscal sustainability. Not getting the deficit down to zero, but just getting it to a more sustainable 3% level is sustainable.
Scott Bessent is going to be responsible for trying to drive some of the president's tax agenda.
So here's the latest. Treasury Secretary designate Scott Bessent's to-do list is already piling up. Former New York Fed President Bill Dudley wishing him luck, writing the following. Markets' exuberant response to his nomination certainly suggests this is what investors expect. Yet their optimism contrasts sharply with the difficulties he'll encounter in managing the Treasury market, the country's fiscal trajectory and the broader economy. Bill joins us now for more. Bill, welcome to the programme, sir. Let's get to those 3 points you make. Managing the Treasury market, the fiscal trajectory and the broader economy. Of those 3, Bill, what do you think is the biggest task?
Probably managing the fiscal deficit, since the Treasury Secretary doesn't have responsibility for tax and spending policy. He can opine on it, but can he actually get it through Congress and get the administration to support it? So I think we're on a trajectory right now where it's 6% of GDP deficits as far as the eye can see. And President-elect Trump has proposed things that will expand the deficit as opposed to contract the deficit. So I think that the fiscal outlook longer term is probably the most challenging thing that he faces.
Bill, he gets some say on the maturity profile of US Treasuries. What's your take of what's developed under Secretary Yellen at the Treasury? And what changes would you anticipate in the years to come under Bessent?
Well, things didn't move a lot under Yellen. I think the maturity structure shortened a little bit. The Treasury typically doesn't want to move around the Treasury issuance calendar a lot because it basically unnerves market participants. Regular and predictable is sort of the watchword of the Treasury. So I would be surprised if Bessent did anything that significantly changed the maturity structure of the Treasury debt. I think the biggest problem he faces is to convince his colleagues in the administration that we need more tax revenue, we need to control spending, and that requires making some difficult choices.
Bill, if you were still on the Fed, how would you think about some of the policies and the personnel that have been implemented or announced so far, and factor that into your outlook for next year? You have to come out with a forecast. You got to make a dot next month. How do you even begin to do that?
Yeah, so far the Fed has been very silent about President-elect Trump. There is nothing, for example, in the minutes about the election and the new policy mix. I think, to the extent that things get priced into financial markets, it's sort of hard for the Fed to then ignore them, because if you have prices embodying a certain expectation, how do you not include those prices in your forecast? Back in December 2016, the Fed staff put a big fiscal stimulus in their forecast for 2017. So when Powell says we don't assume, we don't speculate, we don't guess, the reality is if the markets start to judge that something's highly likely, then the Fed has to sort of take that on board in terms of their own thinking. I think the biggest issue in the very short term is what's going to happen to tariffs, because if tariffs are raised to any close to the degree that President-elect Trump is talking about, it's going to be inflationary, it's going to be bad for growth, it's going to be bad for productivity. And President-elect Trump's talking about putting on tariffs on China, Canada, Mexico, on day one. So that's probably the thing that's going to happen most quickly. The fiscal stuff is going to take longer because the tax cuts don't expire to the end of 2025. So that's probably more of a 2026 story.
You said that tariffs are going to be inflationary. We've heard some disagreement about that around this table. Some people say that maybe in the very short term, there's a one-time price increase. But longer term, tariffs have been shown to be disinflationary time and again. Why do you think that that's not going to be the case?
Well, they're disinflationary to the extent that the people who are buying these now more expensive goods don't have as much real income, and so they can't buy as much, and that hurts the growth rate of the economy. So there is a effect on growth. The key question of tariffs is when prices go up, do they get into wages? The first Trump term, the increase in tariffs was well advertised, but the magnitude was actually quite small. It went from about 1.5% of imports to 3% of imports. The magnitudes he's talking about this time are much, much larger. So the price effect will be much greater, and I would expect that at least some of that will get into wages. And if it gets into wages, then it keeps going. It's not a one-time effect.
Bill, do you think that because of the uncertainty around policy and the potential for some of these policies to be inflationary, do you think on the margins that could push more members to really want to go even slower when it comes to rate cuts?
Eventually. I think right now the Fed's still on monetary policy is restrictive. The dual mandate objectives of employment and inflation are roughly in balance. We need to head towards neutral. And so I think they're still on a trajectory to go towards neutral. But I think, as they've said more and more recently, carefully. So December is not a done deal. I think it's probably more likely than not at this point. It basically depends on the economic data. And, the Fed is basically data dependent at this point. This is one reason why Bessett's idea of putting in a shadow governor at the Fed to basically make pronouncements as Powell's heir apparent makes a little sense, because what the Fed does over the next year is really going to be driven by events.
Bill, how messy would that be if we had a shadow chair in the middle of next year?
I think it's an absolutely terrible idea. I think, one, I don't think it would do much. Number two, it would just annoy all the other members of the Federal Reserve. So you'd have this shadow person coming in to be chair after he's probably annoyed everybody else within the Federal Reserve System by undercutting the current chairman. That doesn't sound like a good recipe for success when you think about the chairman's power comes from his ability to move the committee and achieve consensus. So I think the shadow chairman, if he did what Bassett implies he would do, would alienate most of his colleagues on the Fed.
Bill Dudley, thank you, sir, the former New York Fed president on the Federal Reserve through the next year. Bill, have a wonderful Thanksgiving. Would be interesting if they chose someone inside the hen house and nominated them ahead of time. And they're already on the FOMC.
Oh, can you imagine? Mean Girls, right? Can you imagine the idea of what that looks like in the meetings, especially if Jay Powell is trying to get the sort of coalescing of the whole group, and this other person is saying, like, I don't know. You think that's really the way to go?
It's going to be an interesting few months. I think it really begins in December.
And
it really starts in December.
I would agree with that. And it's also unclear, is it the idea of trying to moderate the message that how it's basically interpreted by markets, or is it about getting through some policies that are harder core, that are a little bit harder for the markets to handle, because some pain is necessary for this decoupling, as the nominee for the trade representative has said?
You're going to see a lot of redistribution, big realignment. We're going to see a lot of cuts to spending, a lot of decreases to taxes as well. At the same time, we'll see some increases to tariffs. There's going to be a lot of changes in the next 12 months. There are a lot of cross currents that the Fed's got to grapple with.
That the Fed has to grapple with, that companies have to grapple with, as well as the existing economy and where we're coming from, that people still can't agree on. Is it actually much stronger than people expect, or much weaker? And you can get the Andrew Hollenhorst weaker, or you can get the Matt Lazzetti Deutsche Bank coming out and saying it's much stronger. So, right now it's a muddle, which is the reason why people are saying, I'm going to go have turkey. I'm maybe going to skip the coffee.
Going to do the same thing.
And then I'm going to buy stocks, and then I'm going to sleep well at night, and then next year, come in and try something else.
And enjoy the Savita Subramaniam Cyclical Inferno. Did you see that over at Bank of America?
Cyclical Inferno.
Cyclical Inferno. We'll cover that in a moment. Up next on the programme, Venu Krishna of Barclays, Sucharita Kodali of Forrester Research, Lindsey Piegza of Stifel, and Drew Matus of MetLife from New York. This is Bloomberg.
Trump is very clear about what he wants to do, and investors need to take that seriously.
I think the market understands that tariffs are going to be part of this agenda, and I think they've digested that already.
This is a game of chicken, and it has to be treated as such.
There's still weakness within the economy. You can see the bifurcation, and that to me still raises risk. And you have an equity market that is priced for perfection.
The hard part about these type of things is just the unpredictability of it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
You all saw the headlines: additional 10% tariff on imports from China, 25% tariffs on products from Mexico and Canada. And then the equity market closed at the 52nd all-time high. of 2024. From New York City this morning, good morning to you all. Equity futures down by just 0.1% following a 7-day winning streak on the S&P 500. Outperformance on the Russell, we're up by 0.7% on the session. On the month, we're up by more than 10%. A blowout month of November for the small caps once again. In about 29 minutes' time, a ton of economic data for you. Another read on US GDP, jobless claims, and Lisa, core PCE.
To me, that's the most interesting aspect here. Can that put a damper on some of the holiday spirit that we feel? Not that I'm looking for some dampening, but there is this feeling that maybe PCE comes in a little bit hotter and suddenly that could really shake up market expectations for the Fed. That is the one fly in the ointment. If anyone believes that inflation is actually picking back up again, well, this whole beautiful picture of eat your turkey, feel good, buy stocks starts to maybe wobble just a little bit.
I'm struggling to find a bear on Wall Street right now. The cause for 2025, let's put it this way. In a word, bullish. 6,500 Morgan Stanley, likewise Goldman Sachs, RBC, Lori Calvasina, 6,600, BMO's Brian Bowski, 6,700, Deutsche Bank's Binky Chada, 7K.
Ultimately, people are looking at a policy mix of yields coming down of the Fed that is going to be easing and, frankly, fewer regulations that are going to unleash financials. Find me a bear on financials right now. I basically find one person after another who's just completely pulled up on financials. You're looking at the potential of some sort of ongoing tax cuts and the baking in of existing ones and even additional stimulus. It paints a picture at a time where the economy already is strong. And that is what I think a lot of people are leading into and saying, you know, this is a great time. We feel good. How high can we actually get those multiples?
Get ready for that cyclical inferno over at Bank of America. Savita Subramanian, by the way, what was the price target? 6666.
Yes, congratulations, Savita Subramanian.
Nice, Savita. Well, it got the attention you wanted.
Yes.
9 reasons she's given for this. It's TV, I'll give you 4. Red sweep, Fed cuts, accelerating profits, reshoring.
Yeah, essentially, this is Buy America. This is America exceptionalism, and that's where you start to look at the pockets within this. She also says buy stocks, not the index. And what we've seen is there are certain areas that have gotten beaten up, whether it's auto manufacturers, whether it's certain healthcare names, and it's coming to a policy mix where suddenly those most exposed to international could get hit harder in certain specific ways.
The index this morning softer by 0.1%. Coming up this hour, Venu Krishna of Barclays with the S&P 500 on a 7-day winning streak. We'll speak to Sucharita Kodali of Forrester Research on why department stores could see a rough Black Friday. And Lindsey Piegza of Stifel looking ahead to the December Fed decision. We begin this hour with stocks at all-time highs after the S&P 500 set its 52nd record so far this year. Venu Krishna of Barclays saying for US equities, we think macro positives outweigh the negatives heading into next year. Post-election uncertainty has been resolved. Oil prices have shrugged off the Middle Eastern war for over a year. Jobless rates remain low, household wealth is up, and the Fed is cutting rates. Venu, what's not to like? Good morning to you, sir.
Tough question. What's not to like? Everything seems to be going the way you want it to go. But I think there are significant amount of uncertainties. And I would just probably point out 3 of them to you, which we kind of try to bake into our bull and bear case scenarios. The first is AI related, right? Will the build out pan out the way people expect? Will it be monetized at the pace market expects? And will that result in a decent return on investment, both for the tech companies and also for companies who are implementing it, right?
Let's pick up on that last point before you carry on, because I want to pick up on that and just dig a bit deeper. Do you think next year is the test for that? Because there has been a degree of patience shown by investors to, let's say, NVIDIA's biggest customers so far. Is next year going to change?
I think we are still very bullish on that part of the market. But yeah, certainly I think we've already seen that. The market is increasingly paying attention, and the scrutiny is on AI monetization, right? And that's why if you saw 2022, the peak multiples were 37 times for big tech. Then this year, the peak was 34 times. Now we're trading at 30 times. So the way the market is expressing that expectation is saying, you know what, now is the time where I want to pay more attention to the multiple I'm paying and show me you can deliver that in earnings. And the good news is they are still blowing numbers out of the park. And they are delivering more than expected.
Just to build on this, though, and sorry to cut in here, because we're talking about AI and big tech, but it goes beyond big tech, right? We're talking about Are we getting to the point where people want to see the broadening out in the use cases of AI to the likes of PCs, with the likes of HP and Dell still struggling to get that upgrade cycle? Do you need to see that trickle out into the rest of the complex to get to some of these lofty targets? Yes, there is the big tech monetization, but it goes broader than that, and is next year the year where that has to be proven out?
Absolutely. So our view is that, on the earnings front, it is very clear that if you look at the big tech group, their earnings are moderating, but the pace of moderation continues to be much slower than what the street expects, right? So they are still killing it. So second quarter, the expectation was to deliver 19% growth. Guess what? 33% is what we got, right? So that is happening. But I think that's the reason why we keep pointing people to the multiple part of it. And that links to your question that you need to see much wider applications. You need to see tangible benefits for companies. You need to see that improvement in productivity. I think there are parts of the economy and certain applications where it will work. It has a lot of promise. People talk about healthcare, people talk about education, but it is not fully there, right? And I think as we keep heading every 6 months, 3 months forward, increasingly the focus will be on all this money spent, all this hype, where are the tangible results?
So Sucharita Subramanian came up with this headline. It was not AI, from 666 in 2009 to 6666 in 2025. But there is an increasing application of artificial intelligence at a lot of financial firms. Is that one of the reasons why everybody is so bulled up on financials? Yeah, you've got the deregulation, but you also have efficiencies with certain large language models that actually can be applied in very real ways now, and maybe ways that they can't with predictive models in education or healthcare fully.
To be honest, I think it is, maybe there are some examples. I can see that. I don't have tangible examples for you to say where in financials it's actually showing up. But I think the excitement in financials is not just AI related. It has a lot to do with deregulation. It has a lot to do with the expectation that deregulation in itself, for example, will create increased amount of capital activity. That will unleash the animal spirits more on the corporate side as well, so that they are emboldened to engage in more capex spending and things like that. So I think financials is not just, and of course, the fact that if the yield curve steepens as the front end gets cut, all that will be good for the net interest margins. Meanwhile, the consumer is still in pretty good shape. So I think that is the deregulation shackle, and the fact that you can deploy more capital, that you can have more corporate activity, that is a bigger driver, not AI in my mind.
Which is why we can't find a single guest that does not like financials in 2025. It's got to be the most consensus overweight for next year. What don't you like? What don't you like on the S&P 500? Which sector do you think gets left behind?
There are we are not big fans of financials. We are neutral on financials because we think it's too expensive. We think it's already priced in. Unless there is a significant ramp up in earnings, it's tough to justify an upside. So we are neutral on that.
Interesting.
Right? We are negative on staples. We downgraded staples to negative because there's ongoing margin pressure over there. Remember, staples were one of the few sectors in which, not few, among the sectors which benefited from an exercise of extraordinary pricing power post-COVID. And they were telling us that demand has become very inelastic. We were skeptical. Guess what? Demand is elastic, right? And so you're seeing that. There's concern about volume growth. There's concern about margins. We are negative on commodity areas. We're negative on energy. We're negative on materials.
Let's pick up on energy. Yeah. Why?
Well, demand is slowing. The oil market has shrugged off geopolitical risk. It's all around us. Oil is still, relatively flat to down. And the big story for energy, last year we loved energy a lot, was about the fact that the story is more about return of capital and return on capital and less about capital spending. But right now, their earnings momentum is downwards. The commodity is not going up. Global demand is moderating, especially outside the US. So, those are some other factors which tell you why energy is not the hottest place to be in, even though the new administration, there's this feeling that they're going to pump up oil. There's excess supply, and we want to pump more. Go ahead.
Well, that's exactly what the Exxon CEO came out and said recently, which is drill, baby, drill isn't going to happen with the price-demand dynamics that we have right now. There is this question, though, about what the inflation hedge then is, right? You're talking about the tail risks, and a lot of people are saying that the tail risks have gotten wider. Energy used to be the hedge against inflation. Is it no longer the correct hedge for inflation?
Actually, it depends on the source of inflation, right? Because when you talk about inflation, people break it down into many different components. But I would still think that actually if you have a serious inflation problem, energy probably will end up being a reasonable hedge right now. But there are better alternatives. There's gold, right? Why would you not go there? At least it's a finite fixed commodity, and of course there are its own dynamics over there. But yeah, there are different hedges. But ultimately, even when you think about inflation, it is what is happening in the rest of the world, what happens to demand for treasuries, right? You can have a situation in which you have higher inflation, but the treasury doesn't react as much because it is still seen as a safe haven, for example.
Yeah, we've been talking all morning about the tariffs and the proposals and why markets haven't been responding more. We haven't really mentioned it once as we've been talking to you about your outlook. How do you take this sort of panoply of personalities and proposals and threats and bake it into some sort of outlook for next year? How do you start to do that, or do you just say, I'm going to ignore it until something actually comes to paper?
Actually, we've tried very hard, and I must confess that it's extremely difficult because there are so many, what if they do this? Is it just posturing? Is it just the starting point? How serious are you? Do you take them literally, or do you take them seriously in what they're saying? So all that. So what we have done is first is let's figure out what we can quantify, right? And we quantified and said, forget about everything else. If they go ahead with their policies of 60% on China and 10% rest of the world, we used macroeconomic data. Companies don't tell you what their exports and imports are. So we used macro data to create a framework, and we estimated that if they do all that and the world retaliates, which they are most likely to, the earnings hit will be about 5-ish% on S&P. If they do 50% of that, our estimate it's going to be around 2-ish%. So quite high, but not that bad. But what we are struggling to capture is the second-order effects, which are far more important than the first-order effects, which is what happens to inflation, what happens to economic growth. So to give you a perspective, our economists believe that if they go full throttle with this tariff scenario, inflation will go up 90 basis points, and US real GDP will decline 1.4%. China's GDP will negatively be impacted by 2%. European GDP by about, I think, 0.7%, if I remember the numbers. So, that is pretty serious, right? But I would like to believe that this administration, is smarter than that. So this is part of a bigger game plan of how they want to address various issues. So, but that gives you the magnitude. And it is a second-order effect, which is extremely difficult for us to quantify. But where it does broadly percolate is the notion that, not in itself as that driver, but we are expecting economic growth to moderate next year. So the last 2 years, we've been printing closer to 3%. Now we're expecting to go to around 2-ish% for this next year. So, it's extremely, if anybody tells you that they've got it, I mean, I'm a seller. I'll short that right away.
Venu, this was thoughtful. It's good to see you. 6,600 on the S&P next year?
Yeah.
Good to see you. Appreciate it, sir. Thank you. Have a happy Thanksgiving. Venu Krishna there of Barclays. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief. A ceasefire between Israel and Hezbollah starting early this morning. The 60-day truce putting a pause in the 14-month conflict that's killed thousands and forced more than 1 million people to flee their homes. Elsewhere, shares of Dell and HP are falling in the pre-market. Both companies reporting revenue that missed analyst estimates, suggesting a longer-awaited recovery of the personal computer market is stalling. And finally, get ready to pay more for your morning cup of coffee. Arabica coffee futures hitting the highest price since 1977. Global supply worries have pushed prices up 70% so far this year.
That's just depressing. I mean, come on, you can't even enjoy your cup of Joe.
I'm not a coffee drinker.
I know you're not a coffee drinker. I love espresso. A good cup of espresso or a cappuccino. Really excellent, well brewed. Right temperature, right amount of grinds, washed out perfectly. It's very depressing to know.
You take this stuff really seriously, don't you?
I come from a household where it is religion.
Okay, that's serious.
Oh, yeah, big
They're
time.
like buying all the stuff that goes with it.
Yes, including a little weighing machine to make sure that you have the right number of grinds, but that just indicates that some people have too much time on their hands. Sorry.
You speaking directly to individuals at home there?
Dad.
Okay, Dad. It's Dad that does it. Okay. Up next on the programme, the morning calls, plus Sucharita Forrester on the winners and losers this holiday shopping season. That conversation coming up next. This is Bloomberg. The open about 1 hour and 12 minutes away. Equities recovering. We're down not even 0.1% on the screen right now. Your scores look like this. Elsewhere in the bond market, yields lower by 5 basis points. The 10-year 4.25. Let's get you some morning calls. First up, UBS upgrading Dick's Sporting Goods to buy, expecting more sustainable earnings growth ahead. That stock up another 1.9%. Your second call from Baird, downgrading Coles to neutral, citing pressure in the retailer's core apparel and footwear business. That stock just about unchanged, hammered yesterday following numbers. And finally, Citi upgrading Urban Outfitters to buy, noting signs of recovery in the company's namesake brand. That stock is higher by 13%. Retailers gearing up for Black Friday and the holiday shopping season. Sucharita, Forrester predicting most e-commerce will do well. Certainly Amazon and the web divisions of most retailers. The department stores will struggle again, as will some of the mall merchants who have been facing heavy competition, like the Gap. Sucharita joins us now for more. Sucharita, walk us through the department stores first. It's been a challenge for years. Why hasn't it been addressed? I think we've got a problem with the microphone for Sucharita there, and hopefully we can re-establish that connection in the next 60 seconds or so. Sucharita Kadali there of Forrester Research. A problem with the microphone at Sucharita's end. We'll fix that. But it has been a problem for a while, and we talked about this a little bit earlier when we had the same problem talking about retail numbers. Walmart's doing well. Everyone else seems to be struggling.
And there's raises the question of how much is this a product mix, how much is this just a cannibalization of the largest players, and how much is this something more existential about consumers and the pushback on pricing? Key question to me is, are we moving into a slower growth era that is fine on the macro level, but that really will pick winners and losers and really create some negotiating heft for the largest, particularly with the backdrop of tariffs?
So when we got Target and they stepped on the landmine, inventory worries. It was a story we talked about ahead of the numbers. There was potential that we'd have some problem with inventory. Park Target, focus on Walmart. Numbers were good. Something you pushed back on almost immediately was any conversation that somehow because Walmart is doing well, the rest of the country is struggling. What has changed over at Walmart?
You know, they are catering to a higher end consumer. They also have a million different offerings, right? I mean, is Walmart still a retail company? You're talking about, yes, the Staples company. Yes, you're talking about groceries. Yes, you're talking about also a marketplace similar to what we see over at Amazon. We see a shoe brand. We see higher end merchandise and, oh yeah, advertising, media, and also just that kind of e-commerce aspect to it. So you start putting this together and it gives them that leverage and ability to really maneuver at a time where the base business of retailing can be fickle.
We are thankful this morning because we get the second chance of speaking to Sucharita Kadali of Forrester Research. Sucharita, we'll try again. Thanks for being with us. I understand you heard the question, but you didn't get to answer it, so we'll start there again. Department stores, it's been a struggle for a long, long time. What aren't they doing right? What do they need to fix? Is it fixable?
Well, I don't know that it's really fixable. It's really a sector issue, which is really, it's widespread. It's because consumers just haven't been shopping as much, particularly in the B and C tier malls, where a lot of these department stores have heavy concentration. We're talking about Macy's, we're talking about Kohl's, of course, JCPenney. These are the anchor stores that really thrived in like the 1980s and even before, but essentially, since 2000, they have been on a downturn. A ton of competition, certainly from e-commerce, certainly from higher end stores and brands, really, that have decided to all go direct to consumer. So that's been some of their biggest challenge. And I don't know that it's necessarily fixable. It's really a shift in the retail landscape altogether.
Sucharita, what does this mean in terms of just how much this land could shift going forward? Because if the whole model of a strip mall is outdated, well, there's a lot more carnage to come.
Well, we've talked about the transformation of these retail venues for a long time, and a lot of it is about switching out the real estate with other anchor tenants or breaking up the anchor tenants into smaller plots where you have perhaps smaller tenants that are in them. We've seen these anchor tenants switch to everything from grocery stores, which are growing, to gyms and fitness facilities. In some cases, it could just be a mixed use facility where you're transforming it into some sort of an office space. In really, really distressed areas, we've seen some of these anchor tenants become churches or schools or things completely unrelated to retail.
All I can say is I provide some research at home, some research regarding retail with some of the family members, and I hear a lot about drops of different types of products and different influencers that are doing said drops. Is the entire model of retail fundamentally changing in a way that some retailers like Gap are really aware of and others are kind of struggling to really get on board with?
Well, there is no question that the internet has absolutely changed it. And you were talking a lot about Amazon earlier. That's certainly the biggest player, but definitely the social media the social media players are also impacting how people discover goods, where they actually shop for goods. And what we're seeing even within e-commerce is a lot of fragmentation, particularly with smaller, lesser known players that are able to gain some traction because they are able to get some influencer credibility for a short period of time. Now, if they're lucky, some of them will end up getting purchased by larger players, like some of the beauty companies have been purchased by L'Oreal or Estee Lauder. But that's usually the dream exit strategy for a lot of these companies. In many cases, they simply may go away and other influencers come and take.
Sucharita, 2 key dates now, January 15th, port discussions, 20th. President Donald Trump comes in with a big promise to hike up tariffs. What do these companies do now with inventory? How much do they need to stock ahead of time? And what did they learn? Are they conditioned by the mistake that Target made?
Well, the truth is that it is probably, if you're looking for what is going to happen in January, it may be a little too late already. These are issues that the retail industry has been grappling with since the first Trump administration. And what we started to see was diversification away from some of these tariff markets like China over time. And I expect that that will continue to happen. The good thing is that Q1 tends to be a soft quarter in retail anyway. So it doesn't seem like it makes a ton of sense to be stocking up inventory for that, especially because you don't know what the demand is going to be like in 2025 without better signals, because it is such an uncertain economy at this moment in time. So I think that what we will continue to see is diversification. We'll continue to see changes to supply chain. There will be questions around whether or not Latin America and Mexico are, in fact, good places to be nearshoring versus if they, too, will have tariffs, particularly on some of those soft goods.
Yeah.
So a lot, I think, is still TBD.
And if you get it wrong, you get targeted, quite literally. Sucharita Kadali at Forrester Research. Boom.
That was very good.
Nice.
Well done. Yeah. I just keep the...
You get that at home? You still following? I hope so.
It's so good.
What is it about the number 6,500 on the S&P next year? Here's another one. JP Morgan coming out with their price target for next year. Guess what? 6,500. Up next on the programme, a ton of economic data. That's next. This is Bloomberg. The opening bell 60 minutes away. Equity futures right now in the S&P negative by 0.05%. On the Nasdaq 100, we're down by 0.2%. Some nice outperformance once again on the Russell. So far this month up by more than 10%. We add another 0.8% to that rally. Elsewhere in the bond market, going into this economic data, your scores shaping up as follows. 10-year yields are lower by almost 6 basis points now, just short of 4.25. With a ton of economic data, Mike McKee, where do you begin?
It's a little bit like Thanksgiving as I take over your show to read all through this stuff. Let's start with initial jobless claims. 213,000. That is down from a revised 215. Was 213 last week, so basically no change. The forecast was for 215, so we come in still low. No layoffs. Everybody can give thanks. 1,907,000. Continuing claims, that's up from 1,898,000, and it shows people still having some trouble getting jobs. The durable goods orders come in up 0.2% after a 0.4 decline the prior month. Ex-transportation, though, take out the numbers from Boeing, you get 0.1. And capital goods, not in defense ex-air, what we call the core, down 0.2 after a 0.7 rise the months before. So that is not particularly good news for GDP. That's the first number for business spending in the fourth quarter. Advanced trade goods down 99.1 billion, 99.1 billion deficit. That's down from 108.7. That's on the good news side for the fourth quarter GDP. And then third quarter GDP, we get an adjusted number, a revised number, 2.8%, no change from the initial 3.5%, a little bit lower in terms of personal consumption. And the quarterly price index, 1.9%. The core, 2.1%. The headline up a little bit, the core down a little bit. Now, my two favorite numbers that I'm going to be watching, wholesale inventories up 0.2%, retail inventories up 0.1% after an 0.8 rise the month before. And that was caused by people stocking up for the port strike. Now, are we going to be stocking up for tariffs ahead? That's something to watch with those two indicators going forward. And
so, Mike, just to go through the markets, just quickly, I'll just jump in. Equity's just about unchanged on the S&P. No big moves here. Bond yields still lower by 6 basis points. I wanted to pick up on your point because I think it's really important. You've got two key dates now. Middle of January, the second date really to go over the port strikes issue. January 20th, you've got President-elect Donald Trump coming into power with a very real threat of much bigger tariffs, not just on China, but on Canada and Mexico. What do you expect the data to look like between now and then? How disruptive will things be?
Well, you still got some leftover hurricane data damage, it appears. The initial jobless claims, continuing claims, maybe because people are still without work in that area. But the trade data is going to be hard to know. We're going to have to watch the inventories and see if they start to rise. But we don't really know how serious Trump is and whether he's going to impose all the... And really, when you take it apart, trying to impose those tariffs on Canada and Mexico would be extremely difficult. But it still could have an impact on things. So you might see business spending go up if companies are trying to pull stuff forward. It's really hard to know.
I feel like 2025 is a black box, so let's focus on the now, the here and now, because that's also something of a muddied picture. We've been talking about how it's hard to gauge just how much heat there is in this economy. Looking through these numbers, I'm going to pick back a word that we haven't used for a while, Goldilocks, right? We're talking about unemployment that is not ticking up, at least based on the jobless claims, if those are an indicator in that way. And you're not seeing that inflationary pressure, at least in the revised numbers. How much does this really speak to this idea that we are in this sweet spot that can allow the Fed to cut rates, which is a marginal implication by bond yields, even as the labor market does not show signs of weakness?
That's the question. We are in a Goldilocks situation as far as what you would hear from a macroeconomist or from a member of the Biden administration. The problem is people don't feel that way because they're still paying those higher level of prices, and that bothers them. And they're seeing things in these inflation numbers go up, like insurance. And you guys were talking about coffee earlier. That's the kind of thing that bothers people.
Yeah.
So we'll see what the mood is, the vibe is, as Kyla Scanlon would say, as we get closer. But you were talking about what people's forecasts are for 2025. All forecasts are valid until January 20th. And then you got to start all over again.
I totally agree. They could change very quickly. Mike, stay close. Let's bring in Lindsey Piegza of Stifel. Lindsey, welcome to the programme. It's always wonderful to see your face. The jobless claims number still tremendously low. We'll get payrolls on December 6th, CPI on the 11th, then the Federal Reserve a week after that. Are we on the verge of a pause?
Well, I think this plays right into the Fed's assessment, as we saw yesterday in the meeting minutes, that the concern that drove that outsized 50 basis points in September is dissipating. This threat of emerging weakness in the labor market is not materializing, and yet the Fed, while acknowledging the improvement in inflation from earlier peak levels, has not yet continued on this disinflationary trend back to 2%. So the risks do appear to be leaning in the direction of stay focused on inflation, keep that focus, and take a more tempered and patient approach to additional policy easing, as clearly this is not an ailing economy in need of policy support. And as such, the Fed may try to push through a third-round rate reduction in December. But as we look out to 2025, yes, I do think the Fed is very much on the verge of a policy pause sooner than later.
Lindsey, you've been out front on this issue for quite a while on this programme talking about it. When they sit down together on December 18th and come out with a new summary of economic projections, what will influence that outlook more? The prospect of a policy change in 2025 or just the realisation that the incoming information, as you suggested, has gone against the grain, against what they expected?
Well, exactly. It is the latter. It's the lack of the evolution of the data formulating within the Fed's expectations that inflation would be down to that 2% level on a sustainable basis by the end of 25. We're just not there yet. We're seeing ongoing sticky price pressures. And so as the Fed looks to give us those new projections, that new dot plot, I do think committee members are going to materially revise higher their expectations for longer term rates. By 2026, the Fed says 2.9% is a terminal rate. I think we could see that materially revised higher by 25, maybe 50 basis points, really lessening that outlook for additional rate cuts next year. Again, under the premise that inflation is moving sideways more than anything and not adhering to the Fed's earlier forecast of this more pronounced decline back to 2% on a sustained basis.
Lindsey, where is the inflation coming from, other than some of the policies that people point to, given the fact that we're not necessarily seeing an acceleration in wages, we're not seeing an acceleration in housing prices? This was Matt Miskin's point of John Hancock earlier this morning. Where is it coming from?
Well, when we look at the breakdown, we still are seeing pressure from housing. That's one of the largest components, not just in the PCE at around 20%, let's call it, but in the CPI at about 40%. And shelter costs are still up near 5% on an annual basis. They're not necessarily gaining traction from that long-standing level, but that is making it incredibly difficult for the Fed to get that top-line number back in the range of 2%, that 2% target. We also continue to see upward pressure on wages. Now, again, not an acceleration necessarily, and we have come down from earlier peak levels, but we've been sitting around this 4% mark for some time, which is continuing to, again, add that stationary floor to inflation that the Fed is desperately trying to break through to get us back to a period of price stability, that lower level of price growth.
Lindsey, it strikes me that there's been a real shift over the past couple of months, that back in Jackson Hole, when Jay Powell was speaking, he said that they would not welcome any downward momentum or any weakness in the labor market, any further weakness. In the meeting minutes, we heard a very different tone. We heard that some participants judged that downside risks to economic activity or the labor market had diminished. Are we entering a new paradigm, Lindsey, where inflation readings are going to be more important in some ways than even the employment report?
Well, I think they're still both very important, but it comes down to the risk factor of that evolving data, of those incoming data points. Right now, because the risks of the labor market showing emerging signs of weakness has diminished, as you mentioned from the meeting minutes, that language the Fed used, they're going to be increasingly focused now on the inflation data because that's where the risk lies. That's where the risk against this policy pivot decision in September is going to come from. If we don't see further disinflationary pressure, as the Fed had assumed, and we continue to move sideways or worse, see a reacceleration in some aspects of inflation, the Fed is going to be pushed to the sideline, maybe for 1 month, 2 meetings or longer. And so the Fed right now is shifting that focus, I think, back towards the reality that price stability is far from a foregone conclusion, which I think many committee members had signed off on too early as we approached that September outsized rate cut of 50 basis points out of the gate.
Lindsey, the data has been coming your way, that's for sure. It's good to hear from you. Lindsey Piegza there of Stifel. Lindsey, have a wonderful Thanksgiving. Mike McKee's still with us, looking over the economic data. Mike, you've had about 10 minutes. What jumps out?
Well, I'm looking at the advanced trade numbers, and of course, this doesn't give us a breakdown by country, but exports were down 1.4%, while imports were up by 3.5%. Sorry, food was up 8.6% in terms of imports. So this is what Donald Trump doesn't like. So if this is what's going to continue to happen, we'll probably see some tariff action. Stronger dollar is going to weigh on exports, and demand in the U.S., Lisa was talking about the strength of the economy, is going to weigh on imports, going to pull in more stuff. So something to keep an eye on now that we haven't watched so much in recent years is the trade numbers.
Let's go back to that conversation and continue the conversation we were having with Lindsey. Joining us now is Drew Matus of MetLife Investment Management. Drew, welcome to the show. I just want to pick up on something Lindsey said. She believes we're on the verge of a pause at the Federal Reserve. Do you agree?
I do. I don't think we get a cut out of the Fed in December. And if we do, we're looking for a total of another 75 basis points out of the Fed before they stop the cycle this time around. So, well above kind of where the market consensus is at this moment.
This is a time when a lot of people are focusing more on inflation because of the policies. If it weren't for some of the policies that the red sweep might bring in, and talking about Donald Trump, president-elect, as well as a Republican Congress, how much would we really be seeing the same kind of inflationary pressures that Lindsey was talking about and that your assumption for only 75 basis points more of cuts seems to bake in?
Well, I mean, if you look at long-term inflation expectations, things like five-year inflation forwards, there really hasn't been a significant move post the election. And I think actually, if you look at the policies, right, everyone's focused on the tariffs, but you also have an energy policy, which, maybe there won't be more drilling. But at the same point, what we saw in the last time we had kind of a U.S. energy renaissance was that it capped prices, right? So your average price then was lower than it otherwise would have been. If you throw in the price impact from less regulation, which, if the president does the same thing he did in 2016 and 2024, we should be expecting kind of a lower regulation growth environment, which is also good for growth and good for inflation. And so I think if you look at the totality of the policies holistically rather than individually, it's pretty, in my mind at least, the kind of behavior of long-term inflation expectations makes a lot of sense.
Drew, I know that you're really hot on the balance sheet and the composition. I don't want to get too far into it because it's the day before Thanksgiving and evidently the price of coffee is going up significantly. But there is a larger question of how much technicals are going to be the main driver of bond yields next year versus some of the inflationary expectations. And I say this not only with the Fed's balance sheet, but also with potential issuance from a Treasury Secretary who has talked about lengthening the duration of the total Treasury profile.
Well, my guess is the Treasury will stick with regular and predictable auction sizes and migration. But I do think that a lot of people up until very recently had forgotten that, the Fed had announced that they want to move to a Treasury-only portfolio. And so once you get to the appropriate size of the balance sheet, the transition has to be away from mortgage-backed securities that they hold and into U.S. Treasuries. And so that will be happening probably sometime this year where the Fed actually begins to buy U.S. Treasuries because they've reached where they want on the balance sheet. But now they have to continue to allow MBS to roll off and replace it with U.S. Treasuries. So there's going to be a positive dynamic from a demand perspective for U.S. Treasuries coming from the U.S. Central Bank next year. Now, we'll have to see how other central banks play out and what happens with kind of other users of Treasuries. But at least from a U.S. central bank perspective, the added pressure from kind of the roll-off is going to come to an end and probably reverse itself.
Drew, do you expect big changes to leadership of the Federal Reserve in the next 18 months?
I don't. I mean, I think, when we think about, the post-Powell Fed, who's going to be post-Powell, I think that there's a lot of people in this administration who are basically going to be auditioning for the job. And so I think it's way too early to kind of pick like a favorite there. But there are people who are going to be offering the president advice. And, usually those are the people who get the closer look.
Interesting. Drew, thank you, sir. Drew Matus of MetLife Investment Management. Big conversation on the street about whether they're inside the Federal Reserve right now or whether it is a Kevin Walsh type from outside the Federal Reserve.
There's also a big question about what the policies are most friendly to Trump. I mean, Kevin Walsh, who's been talked about quite a bit, is somebody who's quite hawkish, which means that he might not be as amenable to cutting rates, which is always what somebody who works in real estate seems to want.
Someone who might be the incoming president of the United States.
Just saying.
Yeah.
I mean, it's a little different scene with inflation, et cetera, but just saying.
Yeah. Let's get you an update on stories elsewhere. Here's your Bloomberg brief. President-elect Donald Trump filling out more of his administration, naming Kevin Hassett, director of the National Economic Council, and Jamieson Greer as U.S. Trade Representative. Trump also nominating John Phelan as Secretary of the Navy and picking Jay Bhattacharya to lead the National Institute of Health. Elsewhere, Goldman Sachs warning that U.S. consumers will face significant consequences from Donald Trump's proposed tariffs on Canada. The head of commodity research there saying the 25% levy would raise fuel prices in the United States, which imports almost 4 million barrels of Canadian crude a day. And finally, Sports Business Journal reporting that sports executive Scott O'Neill is in talks for the role of CEO at Live Golf. O'Neill previously oversaw operations at various NBA franchises and theme parks. The Saudi-backed golf league has been eyeing a new CEO since the summer and would likely offer O'Neill the role of commissioner as well. And that right there is your Bloomberg brief. Our saviour, no golf. Especially the face you're pulling at me right now.
Well, I just try.
I don't choose the stories here, Lisa.
I'm trying to figure out the overlap between the experience that you get with basketball to golf. I mean, you can't come up with two more diametrically opposed sports. One that's kinetic and one that's less than that.
Content and distribution.
Okay, that's what it is.
You knew that anyway.
Okay.
Up next, setting you up for the week ahead and your Thanksgiving holiday. Lisa Abramowitz and all that cheer in just a moment. Equities at the moment just about unchanged on the S&P 500 as we count you down to the opening bell. Here's the trading diary. Tomorrow, US markets will be closed for Thanksgiving, so a look ahead to Monday. We'll get S&P Global Manufacturing PMI and ISM Manufacturing as well. Plus Fed speak from Waller and Williams. Tuesday, JOLTS numbers. Wednesday, ADP private payrolls, S&P Services PMI, factory orders, ISM Services, plus the Fed's beige book. Thursday, trade balance and another round of jobless claims. And then the big one just around the corner as well. You get your payrolls Friday. Not too far away. Just over 40 minutes away. About 40 minutes away from the opening bell. With your morning movers, here's Matus Cranny. Good morning, Matus.
Jonathan, good morning. The long variable lag, it arrived in tech this morning, whether it's Dell or HP. Dell, first of all, crashing by 12%. And it is this refresh cycle. We're pushing it further and further away. We, the individual, we're not spending the money on the refresh. The corporates are. Morgan Stanley say, look, this is way overdone on the downside. The stock was up 85% into the numbers. It's overdone. What actually happened here? You had a Microsoft Windows release, and we were supposed to go and refresh. We're supposed to believe in the power of AI, and we need a new PC. Either way you cut it up, the AI server business is lumpy revenue, record high at $3.6 billion. The divergence between the individual and the corporate is stark. Roll it over, have a look at HP. I think it's just another reflection of the same story, but not just as dramatic. They missed on the PC demand, up 2%, but lighter than the street had expected. And also component parts. The cost of components are rising in the manufacturing process. Workday. 10,000 companies use Workday to collate and run their business through the cloud. The stock is down nearly 12%. Slowing fourth quarter subscriptions. So the revenue up 15%, lighter than the market expected at $2.03 billion. Piper Sandler make it very clear. This is the 10th quarter in a row where quarterly subscriptions are slowing. And that is a more malevolent warning sign. Jonathan, happy Thanksgiving.
Matus, we're thankful to you, sir. Thank you very much. Let's turn to the airlines. AAA expecting nearly 6 million people will fly domestic for the Thanksgiving holiday, a nearly 11% increase over pre-pandemic levels. Stephen Trent of Citi optimistic about a consumer pivot to premium travel options, raising the price targets for United, Delta and American Airlines. Stephen joins us now for more. Stephen, good morning.
Thank you for having me and happy Thanksgiving.
Happy Thanksgiving to you. What's behind that call?
Yeah, absolutely. So when we look at what premium consumers doing and who's traveling today, it happens to be relatively wealthy people are doing the trips. And we continue to see for the network airlines what I would characterize as a very constructive push in revenue generation outside of main cabin. So premium, loyalty, co-branded card. We'll see that earnings wallet share continue to shift in their direction.
Does that mean basically higher prices, or does that just mean that we're going to get more layers of premium business, premium economy, premium, half premium economy? I mean, is that what we're looking for, that will basically pad costs so that they can keep it down for the rest of you're just an economy, so get back there, tap in?
Yeah, so I think, you will see some shift, and I would say mix shift. So in terms of the amount of revenue they generate from premium, the weighting of that revenue is probably going to shift to those stronger verticals. So it doesn't necessarily mean, for example, basic economy at the back of the planes, you're suddenly going to have prices skyrocket. But I absolutely think you'll see a mix shift.
So can we just talk about what to expect over the next couple of days, given that a lot of people are going to be going to the airport and waiting in very long lines? Who set up for this? How do airlines set up for the mass crowds, the angry people who are going to be waiting, delays,
There's a lot of anger in the Lisa household this morning, let me tell you. Talking about road rage earlier on. It's going around starting fights at JFK later on today.
We don't have to talk about that. Go on.
No, certainly. Geography is going to play a role. Weather is certainly going to play a role. So if you happen to have...
Are they angrier in New Jersey? Is that what you're suggesting? Geography is going to play a role.
I'm not going to comment on that one, but certainly geography. If you're out west, people are probably watching winter storms in the Rocky Mountains. You do have the FAA, of course, with its limitations. Air traffic control capacity has been a question mark, and that seems to be more intense in the Northeast and Florida than it is in other markets. So are you going to have some hiccups here and there? I think it's kind of impossible to avoid with the volumes going up as they are. I still think it's really good and constructive for the whole group that we're seeing such good flow. People want to travel. So I think the underlying demand picture looks great.
Top pick for next year, just quickly. What is it? Which airline?
So Delta Airlines happens to be our favorite.
Yeah.
On a 3-month basis, we've called out American Airlines as having upside. So they took grief from the previous strategy of pushing too much towards being kind of a discount airline. They've now turned the spigot back on premium. So you see discount airlines desperately trying to add business class. American already has everything it needs to grow that premium. So I think the next 3 months, that's one to watch.
Stephen, good to see you. Happy Thanksgiving, sir.
To you too.
As always. Thank you, my friend. Stephen Trent there of Citi, thank you. And a special happy Thanksgiving to you at home. I say this every single year. And I also say every single year, I mean it that much, a little bit more. And I do, once again, truly, you at home make up the smartest audience anywhere on the planet. And I can say on behalf of the whole team here at Bloomberg Surveillance, we are incredibly grateful. Happy Thanksgiving to all of you, and have a special time with your families. At least try to. If you're Lisa, maybe you're throwing things. I don't know. Given how things have worked out so far this morning.
I'm grateful. It's
Fights, anger,
really
you're
nice.
grateful, thankful, sure. All right.
Good
From New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.